The next couple of months is going to be a really rocky road.
We are at an unprecedented level of uncertainty.
Gold is a perfect manifestation of policy uncertainty.
The uncertainty effects are much worse this time than they were in 2019.
It's almost impossible for me to say, we've seen the bottom, we can break out of this trading range, and it's time for us to add.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get your week started live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Monday with stocks bouncing after snapping a 4-week losing streak. Sentiment improving as officials familiar with the matter indicate the president's major tariff announcement may turn out to be far more targeted. That's leaving investors focused on the incoming data, looking ahead to taking the temperature on consumer confidence later on in the week before getting another read on U.S. inflation.
Yeah, this to me raises the question, what's going to be more important, the current economic data or potentially what the tariffs may or may not be? Honestly, how much credence can you put into headlines that whip around markets when you talk about maybe it's only the dirty 15% that we're talking about with respect to tariffs? Those dirty 15 include China, the European Union, some of the U.S.'s major trading partners. So it really comes down to where the economy is now and how susceptible it is to some of these shocks.
I would frame this as the following. This is a snapshot of where current thinking is, and things are always best described as fluid. It always comes down to the mind of one man, President Donald Trump, and that mind can change repeatedly between now and next week.
And the reporting from Josh Wingrove is that the negotiations behind the scenes are continuing to happen. And even Scott Bessent, the Treasury Secretary who talked about these dirty 15, also said these countries or these unions could come to America first and maybe strike a deal before April 2nd. What I would say, though, is overwhelmingly the reporting is talking about reciprocity and about selective tariffs. I don't think you're going to get the sectoral tariffs come April 2nd. It is going to be country specific. And what I would say to those people is if you have a trade deficit with the United States or your tariff is much higher than the U.S., then you have a problem. But potentially, if you lower your tariff rate, you may be able to be in the clear.
There was a massive focus on this over the weekend, whether April 2nd was the date of peak uncertainty, where we could move past this and equities could deliver somewhat of a relief rally. The day when we have certainty could also be the day when we appreciate the economic consequences of it. Peter Cheer of Academy over the weekend with a thoughtful note.
And this, to me, really goes to the heart of the anxiety right now. No one expects certainty on April 2nd. Let's be very clear. Question is, what is the new paradigm that we're trading within, and how much is that going to have ramifications on the hard economic data? That's why I think that this week's PCE report and personal income and spending report is going to be interesting. That said, it's likely to be more of the same. The hard data showing just everything is status quo and chugging along, maybe a slight deterioration where the soft data deteriorates much more significantly. That's what Deutsche Bank thinks. That's what a lot of people are thinking.
Kicking things off with a better tone this Monday morning. Good morning to you all. If you're just joining us, equity futures firmer by 0.9% on the S&P. Coming up on the programme through the next 60 minutes, we'll catch up with Keith Lerner of Truist following a winning week for equities, Terry Haines of Pangaea Policy ahead of Trump's Liberation Day, and Michael Darda of Roth MKM Partners on positioning for the end of the business cycle. We begin this hour with stocks higher on signs that President Donald Trump's next round of tariffs may be more targeted than expected. Keith Lerner of Truist writing, on a shorter-term basis, markets are becoming stretched to the downside, and our work suggests the market is in the ballpark of a bounce. Keith joins us now for more. Keith, welcome to the programme, sir. What gives you the indication that maybe we are in that ballpark for a better bounce from here?
Yeah, well, hey, great to be with you. Great to see some green on the board this morning. You know, back in February when we last were on the program, we actually downgraded equities when we were around 6,000. Around March the 11th, a lot of our work suggested that the market had gone too far, too fast to the downside. We looked at, we had a two-point contraction in the multiple for the S&P over a 2-week period. Historically, outside the pandemic, the last 10 years, we haven't seen something more aggressive really than that. We saw some technical indicators become extremely stretched. And we also saw some things like the put-to-call ratios also spike as well. So you put that all together on a short-term basis, as we were closer to 5,500 in our work, suggested things had become overdone. But we do think it is a bounce within a choppier range at this point, Jonathan.
Keith, credit to you. You downgraded equities back in February. A lot of people were freaking out about tariffs at the time. It's not just tariffs, though. This is what Bank of America and Michael Hartnett have to say going into the weekend, that DeepSeek and Doge are much bigger Wall Street drivers than tariffs in Q1. And Keith, this is where things get complicated going into next week. How relevant is April 2nd? Have we already discounted the tariff story or not?
I think it is relevant. I mean, it's many different factors happening at the same time right now. But the tariffs are, are certainly a factor. And if you think about a market multiple, a valuation or a P multiple is based on confidence. And the key word we keep hearing is the word uncertainty today. And that uncertainty has led to that kind of quick contraction in the multiple. Now, the markets are not cheap. And by the way, uncertainty, we always live with uncertainties. Are you being compensated for that uncertainty? So listen, I think that tariff, even right now, we reset expectations a bit. We're getting a relief on just something that's perceived to be better than expectations. But I also, going back to your original question, I mean, DeepSeek was a competitor that opened up a different view of the Chinese technology companies that we didn't have, 6 months ago in this market. So I think altogether that also suggests the upside of the multiples relative to the beginning of the year is likely somewhat constrained as well.
To put these ideas together, there's a real kind of question about U.S. exceptionalism based on that uncertainty tax on valuations that already are elevated. And that, I think, is what a lot of people have been grappling with. How much is this just you have to have a different kind of a risk-adjusted metric in the United States with this level of uncertainty that removes some of the luster of former U.S. darlings? Do you think that is an appropriate way to look at market valuations and a reason to be a little bit skeptical of U.S. equities here?
Well, again, I mean, on a short-term basis, we do think we have a bit more upside. I think we can probably rally in the S&P. We're around 56, 67 this morning. I think maybe we can get up to 5,900, 6,000, and then I think we'll see some selling pressure, some choppiness. But to your point specifically, listen, the U.S. still has some of the best companies in the world, no matter what, and some of the best free cash flow, earnings growth, and so forth. I just think you came into this year where you had an opposite as far as expectations, and you've had a little bit of good news go a long way, in Europe. On a short-term basis, you saw it in the fund manager survey about a week ago. You had the biggest 1 month reduction in U.S. overweight. So in some ways now, everyone's kind of this U.S. exceptionalism kind of collapse relative to the beginning of the year. I think on a short-term basis with this short-term rally that we're talking about, I think you'll see money rotate back into the U.S. and probably led back to the Mag 7 and some of these technology names.
So, Keith, can you give us a sense of what the trigger is for that? A number of people have come on and said maybe this flow into Europe is overplayed. Maybe people have gotten over their skis with optimism that Germany really is going to unleash the taps of stimulus and really change structural aspects of their economy that have hindered growth. Are you saying it's a ruse, it's over, it's done, go back to the U.S.?
No, listen, I do think that the fiscal changes from Germany is significant. And I think as you think about, and a lot of what I'm talking about, timeframes matter. If you think over the next year, I think as your allocations, you probably want to have more weight to international than you had, say, a year ago. I'm just saying on a short-term basis, you kind of went to such an extreme. Europe outperformed by about 20% since December, and basically, markets don't move in a straight line. So I think you kind of reset the bar for the U.S. You have an elevated bar for Europe in a short-term basis. A lot of that outperformance in Europe has been defense names specifically. So they've just moved so much that I think they're due for a breather, maybe a little bit of an unwind. But as you kind of have this little bit of the short-term reprieve, I do think, that fiscal stimulus is a big change. DeepSeek is a big change. So again, we're overweight the U.S., but basically what we're saying is like an accordion. You want to kind of bring in those bets as you see this kind of short-term rally that we think has some short-term legs here.
Keith, putting the short-term rally aside, long-term, how do you view the United States? Right now, we're really discussing only one pillar of the Trump agenda, which is tariffs. What happens when you get potentially more deregulation and the extension of tax cuts?
Yeah, and that's the big question right now. I think ultimately, I think that is a positive. After the election, the market was all focused on all the positives. Now, the last month or two, we're focused on all the negatives. In a couple of weeks, we'll start talking about tax policy again. So I think it will be more of a measured picture as we move deeper into the year. So to your question, I still think the U.S. on a relative basis, especially as you look about, longer term, 3 years, 5, 10 years. I mean, the majority of the most successful companies are still in the U.S. So we still want to be overweight U.S. longer term. I'm just saying that relative to the last couple of years, the magnitude of an overweight likely has to come in somewhat because of how much we've outperformed and some structural changes like we talked about in Europe. The other thing that's interesting, going back to China, Chinese tech and U.S. tech moved, basically in tandem from 2015 to about 2021. That's when China started to accelerate, or the government started to crack down more on the Chinese technology companies. So as they've kind of eased up now, those markets have performed better. And I think, again, you're seeing some better innovation out of China as well.
So basically, another way of asking my question is you upgraded cash from less attractive to neutral. You think you need a slightly higher cash level. When would you actually say, no, that cash needs to be put to work now?
Yeah. Well, so again, I think we're going to have a bit of a bumpier just road this year in general. So our overall allocation is, Lisa used to joke with me last year. At some point, we were there strongly neutral again, and we have that cash. We're not really ready yet to deploy it. But, part of this kind of short-term call that we had a few weeks ago that we had to balance is, when we downgraded stocks, it happened so quickly. Some of the advisors we spoke to, they couldn't move that quickly. So it's kind of saying we're down 10%. I want to be selling here. Wait for a bounce back to 5,900, 6,000 on the S&P, and try to dial back exposure more towards a neutral overall exposure. I still think at this point I would hold that cash. I think we'll have some better opportunities because even with the tax policy debate that comes up, we have such slim margins. I think it's going to be a kind of a choppy period.
Hey, Keith, appreciate the update and your view, sir. Keith Lerner there of Truist. Big week coming up. Looking ahead to next week, April 2nd, and so-called Liberation Day. For who? Liberation Day for the equity bulls or not is something we've got to figure out.
Liberation for the uncertainty tax or not necessarily. A lot of people are looking past this. They don't expect this to necessarily be some sort of conclusive moment. What I do find interesting is we are getting challenges to this idea that U.S. exceptionalism is over, that the money that's flowing into Europe is going to stay. Mike Wilson this morning talking about how a weaker dollar will actually support S&P 500 earnings and should bring returns back to the U.S. So a really muddled picture on multiple fronts.
Equities bouncing back this morning to kick off the trading week. We're positive by around 1% on the S&P 500. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara Hackett. Hey, Yahara.
Hi, John. President Donald Trump's incoming wave of tariffs is poised to be more targeted than originally expected. Sources telling us the president's upcoming Liberation Day tariff announcement set for April 2nd is set to exclude some countries from widespread reciprocal tariffs. Meanwhile, SAP has unseated Danish pharmaceutical giant Novo Nordisk as Europe's most valuable company. Shares of the cloud-based software company rising in the current session, giving it a value of $344 billion. Meanwhile, Novo Nordisk shares are down over 17% year to date as it faces pressures in the weight loss drug market. And Disney's Snow White fell short of box office forecasts on its opening weekend. Disney saying the live-action remake delivered ticket sales of $43 million in the U.S. and Canada, shy of its estimated range of $45 to $55 million. That's your Bloomberg Brief. John?
Cost $250 to make. Absolutely bombed. Yahara, thank you. Appreciate it. More on that story a little bit later. Wanted to get you up to speed on this story quickly. The Women's March Madness bracket. Guess who's leading here at Bloomberg? Do you even know?
Yeah.
Annmarie Hordern is winning. 1 point behind. 1 point behind Mark Rowan of Apollo.
As you can tell, she's paying a lot of attention.
I will admit, I cheated. Bria, the producer, sat with me.
Oh, Bria did this for you?
And we did it. It was a joint effort, but we went line by line together.
She typed, Bria talked.
You're at the top of Bloomberg LP. Worldwide, globally, including everybody else, you're just 1 point behind Mark Rowan of Apollo.
Thanks for that news, Jonathan. Happy Monday.
Let's see if this sticks. Up next on the programme, we're counting down to the tariff deadline.
April 2nd is going to be Liberation Day for America. We've been ripped off by every country in the world, friend and foe. That money's going to be coming back to us in the form of tariffs. They're tens of billions. It's going to be numbers like nobody's ever seen.
Up next on the programme, Terry Haines of Pangaea Policy, live from New York City this morning. Good morning. Annmarie didn't know, and now it's the only thing she's talking about.
I'm leading in the bracket, have you heard?
Yeah, seriously. The rest of the day is wrapped.
Equity futures on the S&P just about positive. A nice bounce. We're up by 1% on the S&P 500. Yields are higher by 3 basis points. The 10-year 4.28. Under surveillance this morning, we're counting down to the tariff deadline.
April 2nd is going to be Liberation Day for America. We've been ripped off by every country in the world, friend and foe. We've been ripped off on trade. We've been ripped off on military. We protect people and they don't do anything for us. It's just so unfair for years and years. And Now some of that money is going to be coming back to us in the form of tariffs. There are tens of billions. It's going to be numbers like nobody's ever seen.
So here's the latest this morning. The White House narrowing the scope of tariffs set to be announced on April 2nd. Sources telling us here at Bloomberg the levies will now exclude some nations, and the president's previously announced sector-specific tariffs are now on hold. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, some of our reporting over the weekend. Why don't you give us the headlines and what's changed relative to expectations going into next week?
Well, John, the biggest headline appearing to be that the White House is no longer planning to implement those sector-specific tariffs on April 2nd. As you know, these were tariffs against specific sectors that President Trump had singled out, including on autos, pharmaceuticals, lumber, and chips. To give you an example of how quickly this has changed, it was exactly 1 week ago today, March 17th, when President Trump told reporters coming back on Air Force One that we could have expected those sector-specific tariffs to be stacked on top of the reciprocal tariff plan. Now, at this moment, it does not appear that they are moving ahead with that on April 2nd, but it could come later. And then the other important part of this reporting is that it now appears that the broader reciprocal tariff plan could be pared back and that some countries could be excluded if they don't have tariffs on the U.S. or they run a trade surplus. Importantly, NEC Director Kevin Hassett said on Friday that he felt that markets needed to change their expectations because not every country cheats the U.S. with trade, as he said. But to be clear, that has not been the messaging until really last week when we saw Treasury Secretary Scott Bessent say that we could expect them to target the so-called Dirty 15, the top 15% of our trading partners that make up the bulk of the imbalance with the U.S. here. John, importantly, though, we should note that these tariffs could still result in levels not seen in the U.S. in decades, and this White House really is banking on tariffs bringing in revenue. But at the same time, this is considered to be a more tailored and narrowed down approach.
Tyler, when it comes to how the president is thinking right now, he did say something along the lines of, I don't change, but I like the word flexibility. You have to be flexible. How much are we seeing negotiations play out now before April 2nd?
Right. Well, for one example, one thing that's still held from over the weekend is that we're not expecting carve-outs as of now come next week, even as these negotiations continue, particularly with private sector companies coming in and out of this White House for negotiations. We did see one serious step in talks, particularly when it comes to China over the weekend. U.S. Senator Steve Daines, a Republican from Montana, returning from Beijing, becoming the first top U.S. official to meet publicly with a Chinese diplomat since this administration has started. But still, as we move forward, as of now, this administration saying that it is going to particularly target those countries, and we know that President Trump, when it comes to how he feels that countries are either cooperative or being more combative, will be factored into this. That's why we're also particularly watching the European Union and those specific countries that we are expected to get hit with those tariffs. Just quickly, Annmarie, I would just add that we saw Australia, one of those countries that had been really hoping particularly for those steel and aluminum exemptions over the weekend. Their treasurer saying that they expect seismic shifts to the global economy as we start to hear that rhetoric ramp up ahead of next week.
They're not alone, Tyler. Appreciate it. Tyler Kendall with the latest. Thank you. Something we haven't given a ton of thought about, given the rally abroad we've seen, particularly in Europe and in China. But the weaker data started to emerge last week. Might just be a small data point for financial markets, but business confidence in Canada absolutely collapsed. This is not something the market is really traded on, but it's something we could be trading on in the months ahead.
And it's something that the Bank of Canada is maybe moving on or not moving on in response to that potential weakness, because they do see it coming down the pike, which raises this other question. People seem to be going into the rest of the world because suddenly they don't think that they're going to suffer as much as they did earlier this year in the heels of some of the tariffs that are about to be placed on. Will that get rethought as we do get some more details about what these tariffs are going to look like?
Terry Haines of Pangaea Policy joins us now for more. Terry, welcome to the programme, sir. Good morning to you. Let's just start with your base case. What do you expect to see April 2nd?
Well, really two things, John. One is I think your reporting has been excellent on the idea that these are going to be kind of less sweeping, less hammer-like. But I think markets trade one kind of uncertainty for another. My touchstone on this has always been Secretary Bessent's view that tariff direction is always path dependent. And what he means by that is the reaction of other countries outside the United States to what the United States wants in terms of lessening or rationalizing tariffs and economic behavior more generally. And, I think what you're going to get is you may get less than meets the eye on April 2nd, but at the same time, what you're going to see is a lot of negotiations between an awful lot of countries and the United States about how to lessen tariff barriers and, or if failing that, maintain them, and maybe some non-tariff changes as well. So, again, one kind of uncertainty for another kind of uncertainty, I think.
Terry, Jonathan said earlier today the most correct word when it comes to situation, fluid. What kind of behind-the-scene negotiations are having, basically? What's Peter Navarro saying versus what's Kevin Hassett saying?
Oh, well, I'm sure they're negotiating among themselves, and Navarro, of course, is a hardliner, whereas Hassett so much isn't. I would look to what's happening outside the United States as well. I know full well that Commerce Secretary Lutnick's people have been giving sets of tariff and non-tariff requests and demands to different foreign countries so that they can react, respond, and hopefully change things. And that's one of the reasons why I say that I think going forward here, this is very much going to be an uncertain field. This doesn't end April 2nd one way or the other.
Well, when Scott Bessent was talking about the Treasury Secretary, the Dirty 15, he also talked about that some of these tariffs may not go into place because a deal was negotiated beforehand. Do you expect a number of countries to negotiate deals before next week?
Yes, I do. I think some do, and and a lot don't, and that depends on their individual political and market situations as much as anything else. The nimbleness of their governments and the ability to react and respond to what the United States might want, and on the other hand, the coherence of how the United States, frankly, communicates its own demands and requests. I mean, we've seen that before on, for example, on Canada and Mexico tariffs, and I expect that to continue here on a worldwide basis, frankly.
Terry, maybe this is inside baseball, but when I was reading all the stories over the weekend about how the tariffs wouldn't be as broad-based as previously expected, I was thinking, who's leaking this? What is the reason behind the concerted effort by the White House to send the message, hey, guys, it's not going to be that bad? And I'm wondering, is this a message to markets or a sign that this White House cares more about some of the turmoil in markets than perhaps they're letting on?
I think probably a little bit of both, but I think more of the first, frankly. The president's statements are fundamentally not for markets. Markets should pay attention to what the president says, of course, but they're fundamentally not for markets. Presidents are tone setters, and Trump is very good and almost over the top at tone setting. But what you're getting underneath that from Bessent, from Lutnick, from others is a desire to tell markets that, look, the reality of this is going to be somewhat different. It's not going to be completely different than what the president says, but there's going to be more nuance and sensitivity to market concerns.
Terry Haines of Pangaea Policy. Terry, appreciate it as always. This is something we've suspected now for quite a while. The task was already pretty large to unveil all of this on April 2nd. Maybe you will see all of this unveiled on April 2nd. But to actually see the policies implemented may take months and months after that, which is something, Annmarie, you've indicated time and time again over the past few weeks.
Especially if we don't know exactly how they are going to enact these tariffs, meaning if it's IEEPA, Donald Trump can do it day one. That's a national security lever. But if it's 232, 301, they will need to have more of weeks or months to get public comment. What I think is very interesting is this week, Jameson Greer, according to Jenny Leonard, is getting on the phone with his Chinese counterpart. You see a lot of conversations taking place in the lead up to this Liberation Day.
The conversations, though, have different themes. Are they about fentanyl? Are they about immigration? Are they about trade imbalances? Are they about something else that really doesn't have to do with anything above? So these are the reasons why it's difficult. When you talk about the Dirty 15, we're talking China, European Union, Mexico, Vietnam, Taiwan, and Japan. So, just those.
It's quite a phrase, isn't it? The Dirty 15.
Yeah, it's not a small little group either.
It's pretty ugly stuff. Coming up on the programme, Frank Aquila of Sullivan and Cromwell as the FCC threatens to block M&A for companies with DEI. That conversation up next. So a little bit of hope this morning, informed by a lot of reporting. Equity futures positive by 1% on the S&P 500. The hope, informed by our reporting, is that maybe the barrage of tariffs for next week you all feared might be more targeted than expected. That's unlocking some gains across the board this morning.
Yeah, talking about not necessarily on sector specifics, but more broadly on the ones, the companies, the countries that have the biggest trade imbalance. We keep talking about the so-called Dirty 15. Treasury Secretary Scott Bessent put it that way last week. A real question mark about what the Dirty 15 really is and how high the bar is, considering that they are our major trading partners. So it remains to be seen exactly how narrow these are.
Some of the biggest economies on the planet.
Exactly.
Still very, very important. Let's turn to the bond market. So equities just about squeezing out a week of gains on the S&P 500 and snapping that 4-week slide. In the bond market, yields at the front end now pretty much capped. The belief that Chairman Powell is going to go one way or the other, hold or cut. The 2-year 397.74, yields higher this morning by 3 basis points. Just locked in there, Lisa, around 4.
Last week, after Fed Chair Powell's comments, a lot of people just said this is a Fed chair who is more biased to cut than to remain on hold, because he does seem to be emphasizing the weakening in growth from inflation that he says is transitory. The bringing back of the T word was important. Right now, we're expecting almost 3 rate cuts for the remainder of this year. That is how much it's gotten up to in market expectations.
Let's turn to foreign exchange. Lisa mentioned FX just moments ago on this programme. Euro dollar at the moment shaping up as follows. Positive on the session by a third to 108.51. Mike Wilson of Morgan Stanley, the note that Lisa pointed to. Relative performance versus international developed equities can swing back in favour of the United States. A weaker dollar should offer a tailwind for U.S. revisions.
Because it makes their exports more valuable and more profitable as well. This is an argument people were making on the flip side, that first quarter earnings were likely not to be as good because the dollar had gotten so strong. So you can imagine, if you reverse it on its head, how much that could actually give a tailwind at a time where people are saying that the decline in the S&P 500 in tandem with the weakening in the dollar is some sort of recipe for the end of U.S. exceptionalism. Some people are using it as a contrarian indicator.
The dollar weaker again this morning. The euro stronger. On our radar this morning, President Donald Trump's next round of tariffs on April 2nd, shaping up to be more targeted than expected. Sources telling Bloomberg Trump is set to exclude some countries from widespread reciprocal tariffs.
So potentially this is more bark than bite. What I would caution is there's over 100 countries, and Jenny Leonard was talking to me about this, and she's one of the greatest trade reporters we have in Washington. But Trump really cares about the dozen that have massive deficits with the United States. The question we need to be asking ourselves is those 10 or 12. Does this mean that he's going to bring down that, he's not going to go as hard at them and bring down the reciprocal rate? Or is he still going to be very aggressive on those countries that really matter to him the most?
I just wonder if the cat's out of the bag in terms of getting some sort of deal with certain areas. I'm thinking about Canada and the European Union, where there's a lot of anger, and it isn't politically popular anymore to say, okay, you know what, we're going to come to the table and drop all tariffs. So I wonder how much it's going to make it difficult for there to be certain deals and, frankly, to remove some of the tariffs on the table.
Well, how many times has Howard Lutnick come on this program, the Commerce Secretary, talking about the fact that he's going to be having phone calls with his European counterpart, with the auto companies? The conversations are happening now. What gets done between here and now is still very fluid. But I would still remain, President Trump says he wants to be flexible, but he says there's no change. He's still tariff man.
Elisa, I think you hit on a really, really good point. I hope, and this is my hope, that it brings the two sides together and they can negotiate lower tariffs on both sides. That's the hope. But you're right to talk about public opinion. Public opinion has moved completely in the other direction. I'm not sure that's the centre ground in places like Canada right now. I'm not sure negotiation is what the Canadians exactly want.
It's hardening the lines and saying, actually, guys, no, we have a country and we are our own entity. I mean, to talk about the 51st state is sort of, a kick in the shins a little bit to some of the people in Canada. So, it just raises a question of how much people are going to be more entrenched, even if it makes economic sense to come to the table and eliminate tariffs.
And if the tariffs are going to hurt the United States, you've got to imagine the tariffs hurt Canada. The tariffs hurt Europe. You can't sit there in Europe and say it's only going to hurt America. If you're putting tariffs on too, it's going to hurt you as well.
So this is the interesting aspect. People have kind of ignored that over the past month and talked about European exceptionalism because there isn't a pall of uncertainty. The pall of uncertainty from the United States hangs over Europe as well.
a week away from April 2nd and so-called Liberation Day. Let's turn to foreign policy. US and Russian officials meeting in Saudi Arabia today as President Donald Trump pushes for a ceasefire in Ukraine. Ukraine's defense minister calling talks between US and Ukrainian officials yesterday, quote, productive and focused.
So yesterday, the technical teams out of the United States sat down with the Ukrainians. Today, right now, they're sitting down with the Russians. They're really focused on two things, and this was already agreed upon by the leaders level. And this is basically a moratorium on strikes, on energy infrastructure, and potentially also Black Sea deal. Now, this is the easy part when you're looking at a truce, because these type of negotiations were already happening in 2022, 2023, 2024. They were what I would call off-the-shelf deals. What is going to be hard is getting actual peace agreements on the 20% of land that's Ukrainian that has been Russian held through this war. And I have reporting from over the weekend with another group of Bloomberg reporters that they are very aggressive. This administration wants a deal by April 20th for 30-day ceasefire. That's just in a couple of weeks.
Look, we all hope that this ends up with some sort of resolution. Big question about whether Vladimir Putin will come to the table. That really is the key question at this point. My interest here, aside from that, is Saudi Arabia's role. That they are the epicenter of all of these negotiations time and time again. The sort of circle of power is shifting, and it's shifting to the Middle East.
The new Switzerland.
Yes, exactly.
It's a massive change, isn't it? We'll catch up with Norman Rule in the next hour on that story. Let's finish on this one. Snow White, missing box office forecast on its opening weekend, widely expected to bomb, and it did. Disney saying the live-action remake delivered ticket sales of $43 million in the US and Canada, lower than the estimated range of 45 to 55.
Okay, you could get into sort of the politics and some of the controversies over this movie and the casting and some of the views, political views coming out. It got a 44% on Rotten Tomatoes. Some of the reviews, I love this one. In short, hi-ho, don't go, by Pittsburgh Magazine film critic.
Brutal.
And this one from the New York Times, Manola Dargis, neither good enough to admire nor bad enough to joyfully skewer.
So, $250 million plus to make.
And I mean, what is it with these sort of remakes in human form of these classics that were lovely?
I think part of the problem is people want nostalgia of the classics. David Hand, this American animator, his son, he had passed away, worked on this. His son said that his father would be turning in their graves, the original team that worked on this. He said it's a disgrace that Disney is, quote, trying to do something new with something that was such a great success. They're making up new woke things, and I'm just not into any of that. And it seems that the viewer isn't either. And I think part of the problem you have here is businesses, potentially, there's a lot of controversy around quote-unquote woke, what they should be doing with nostalgic storylines. The issue comes that maybe viewers don't want it and just becomes too controversial. And then at the end of the day, you spend $250 million and no one's going out to watch it.
They become so worried about offending someone, they offend everyone. It's a movie nobody wants to watch. And a bigger issue right now with the Walt Disney Company, and this is a massive issue for them. This is not just sort of cultural identity politics and all of that stuff. Let Washington, D.C. have that fight. This is about business. You've spent almost $300 million on a movie, and it has absolutely bombed. And why? You come across as embarrassed by your own source material. That is not a good position for Disney to be in. And they seem to find themselves in that position time and time again.
If you are going to remake something, you can't just replace certain characters with virtual imagery because you aren't sure exactly how you want to deal with it. It is a question of dealing with source material head on rather than simply around the edges. Oof, we'll have a virtual image instead.
I was looking at some of the movie theatres across the country, just going to various ones and going to like the 8 p.m. in Houston just to see how empty it was. No one's buying tickets for this thing.
You were going around the country?
I was doing my research on the apps last night.
You were doing sort of live mapping.
Honestly, it was absolutely shocking.
That's really interesting.
The channel checks were just not impressive at all. Let's move away from this story because spend a lot of time on this. Let's turn to M&A. Under the Trump administration, the US Federal Communications Commission threatening to block mergers and acquisition proposals from companies that promote DEI policies. That move could impact billions of dollars worth of deals in the communications sector. Frank Aquila, the senior M&A partner at Sullivan and Cromwell, joins us now for more. Frank, welcome to the program, sir. It's not the M&A boom that we quite expected, so let's take a step back. Can you give us the 35,000-foot view? Just what is happening here and where are things going?
Well, a number of things. Well, first of all, thank you for having me on this morning. A number of things are happening. I mean, Secretary of the Treasury Bessent 2 weeks ago proclaimed MAGA does not mean make M&A great again. And I think the expectations that we all had going into this administration, really have been let down. The statement by the FCC chair, I think, indicates that their broader policy focus, is going to be reflected on M&A, and DEI is clearly something that's extraordinarily important to this administration, and the fact that they may, and I think this is still a may, bring that lens to certain transactions is reflective of that. But this is not Ronald Reagan's FTC or DOJ when it comes to merger review. This is much closer. This is a populist version of what we saw with Lena Khan in the last administration.
Frank, one of the criticisms from Lena Khan's administration was that it was inconsistent and that it went after certain companies like affordable luxury that seemed like random made-up concepts that really undermined the confidence that different corporate executives could have about what deals would be signed off on and what wouldn't. Is that something that you're seeing continue in this administration?
I think there is a hesitation on the part of senior executives and boards of directors. I don't think it's necessarily about the merger approval, because I think most of these transactions will ultimately happen, which has historically been the case. The issue is really around the broader economy at the moment. And I think that there are concerns. You were talking a minute ago about rate cuts and the weakening economy and what's going to happen with exchange rates. M&A is not going to happen where there's uncertainty, whether it's about tax rates, exchange rates, the economy. Once there's greater clarity, and I think as we get into this administration in the course of the next few months, there will be greater certainty. And my expectation is that the back half of the year will be quite busy and quite robust, because there is that certainty that is lacking to some extent at the moment.
Frank, I'd love it if you could give us a reality check, because there have been a lot of articles and a lot of histrionics about the undermining of the legal system and this question about how much that's really going to challenge some of the deals and some of the other corporate actions that take place. Do you think that that is all noise and that essentially what we are seeing is just corporations acting logically to an uncertain economic environment, but will come around and will ultimately operate business as usual later this year?
My expectation is that it will be very much business as usual. Will certain companies de-emphasize DEI and some other policies? Absolutely. But, by and large, what we're going to see is what companies do today, U.S. and non-U.S. companies. They adapt to the political and economic realities of the moment. And that's what boards and managements are paid for, is to evaluate that and look at what's in the best interest of their shareholders. How do they create the most value for their shareholders? And to me, that's ultimately business as usual. And so I certainly am seeing that and expect to see that going forward.
Frank, we're already seeing that from the likes of last week, JP Morgan. They came out and they're no longer calling it DEI. They're calling it DOI, diversity, opportunity, and inclusion. Is all of this just about companies rebranding for the Trump world?
Well, I think that, there is largely a misunderstanding maybe created by politicians that somehow DEI was discriminating against certain people or classes, people like myself, older white men. The reality is that it was just making sure that people who were underrepresented, who were talented, had opportunities. So, to some extent, it may be rebranding. I think to some extent, it's also education to the fact that we are, that companies, law firms, investment banks, whatever, aren't discriminating, that they're in fact simply making sure that the best and the brightest have opportunities, are retained and promoted. I think that's what's been happening. And I think that will become clearer as time goes on. So it is a bit of a rebranding and a refocusing.
We appreciate your opinion on that, sir. Thanks for joining us. Frank Aquila there of Sullivan and Cromwell. I wish they'd rename it Development, Opportunity, Investment. And I wish they'd go and focus on socio-economic status and invest in those communities and in education and get all of these massive companies just to do that. And just accept that this is going to take 10, 15, 20, 25 years to do something about, and that you can't just do it at entry-level jobs. You can't just go to a certain group of universities and say, no, we only want one kind of person from one kind of college, and this is who we're going to hire. Because how this worked in practice is not exactly how this worked in theory over the last 4 years.
There are a lot of companies who are doing that. And there are a lot of companies that have programs that go into middle schools, that go into elementary schools. I've seen it. There is just a question of how it's being messaged at a time where the previous regime had one image. This regime has another image. What are companies actually going to do to reach those goals that you laid out? And I think a lot of people would agree on.
Equities right now on the S&P 500, if you are just joining us, positive here by 1 full percentage point. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hakez. Hey, Yahara.
Hi, John. Newly elected Canadian Prime Minister Mark Carney calling for a federal snap election to be held April 28th, while giving a stark warning about President Trump, saying, quote, Donald Trump wants to break us so America can own us. Carney looking to convince Canadians he's the right person to defend the nation against U.S. aggression. Meanwhile, a U.S. delegation that includes Second Lady Usha Vance and National Security Advisor Mike Waltz will visit Greenland this week. The territory's election winner said the trip, quote, shows a lack of respect and is seen as a move to exert pressure on Greenland as President Trump ramps up his rhetoric that the U.S. should take control of the island. And the surprises kept coming during this weekend's March Madness action. Number 10 ranked Arkansas upset St. John's amid another legendary run for head coach John Calipari. Meanwhile, UConn's quest for a third straight title was denied after falling to number 1 ranked Florida. With all the surprises, there are now 0 perfect brackets remaining, according to the NCAA. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on in the programme. Up next, navigating a regime change.
The Fed, like so many others, are navigating a regime change. Communicate in a way that convinces people that you will have the possibility of rate cuts, not because inflation is coming down, the so-called good news cuts, but because growth is problematic, bad news cuts.
That conversation up next with Michael Darda of Roth MKM Partners. Live from New York City, this is Bloomberg. Equities on the S&P firmer here by a little more than 1 full percentage point, bouncing back. The hope that we can avoid a barrage of tariffs next week, informed by our reporting, suggesting that maybe that effort on April 2nd will be more targeted. Bond yields are higher by 4 basis points. The 10-year still around 430 at 428.64. Under surveillance this morning, navigating a regime change.
The Fed, like so many others, are navigating a regime change. Communicate in a way that convinces people that you will have the possibility of rate cuts, not because inflation is coming down, the so-called good news cuts, but because growth is problematic, bad news cuts. Do so without fueling inflation expectations, which already are pretty worrisome. So that is what they need to do.
So here's the latest this morning. Investors preparing for a total shift in global trade. The next round of Trump's tariffs are planned for April 2nd, with Wall Street lowering expectations for US growth. Michael Darda of MKM writing the following. If trade war leads to the end of the business cycle, cyclical sectors will fall hard. However, we feel more comfortable buying these groups on weakness if one can adhere to multi-year timeframes. Michael joins us now for more. Michael, welcome to the program, sir. Let's just sort of back up and get an understanding of where you think we are in this cycle. The soft data has rolled over aggressively. The survey data looks weaker. Is it inevitable from your standpoint that the hard data will come next, or do you think that's avoidable?
Hi, John. Thanks for having me on. That's really the risk here, right? We've seen a really large and pronounced pullback in both business and consumer confidence. Obviously, we know there's not a direct read-through from those sentiment measures into the real economy, but the risks obviously have gone up here in terms of growth slowing or, the business cycle potentially coming to an end. And markets reflect that with the 10% correction that we've seen so far this year. I think we need to be a little careful here. I would not just be, buying the whole index here simply because we had a 10% correction. The investment sentiment surveys have crashed. Usually that's a bullish contrary indicator. But S&P 500 valuations as a whole still remain elevated, more than 20 times forward estimates. And those estimates by our analysis are probably 8 to 10% too high here. So I think you got to pick your spots.
Michael, that's exactly where I wanted to go. The idea that sentiment surveys have been so bearish that typically is a sign to buy, and why you don't think that is necessarily a buying signal today. I just wonder what you would have to see in the economic data to give you confidence one way or another, because a lot of people are saying don't pay any attention to the hard data because it's lagging so far behind some of the quickly moving soft data.
Yeah, that's really the critical question. And even these February releases that we're going to get this week, they're important, but maybe a little bit stale. So unfortunately, I think we're going to have to see a few more months of data to see if this uncertainty, which is really ratcheted up dramatically, is starting to chip away at the real economy. Two things to focus on, I think, would be critical labor market indicators. Obviously, layoffs have stayed fairly low and stable here. First-time jobless claims are, only about 10% above where they were right before COVID crashed the economy. So that's still a pretty good level. If that starts to shoot up, I think that's going to really dent confidence in the soft landing continuing. And we're seeing some cracks in the high yield market. Obviously, the spreads are still very, very low, but they've been moving higher. So I'd watch those two really carefully as we move forward.
Mike, just quickly, one thing that Jason Furman commented on over the weekend, who is former chief economic advisor to President Obama, he said, everyone always overstates how much presidents matter for the economy. Is what we're seeing in terms of the weakness what was already in the economy heading into this year?
Well, I think in terms of the hard data, for sure, definitely not in terms of these confidence measures. And I think those are certainly responding to the headlines. And I think that comment is correct. I mean, typically presidents don't have that much sway. I mean, obviously you have to work legislation through Congress. In this case, because you have so much of the policy changes on tariffs taking place through executive orders, I think it is a little bit different. And we can certainly see that in the behavior of financial markets, confidence surveys. Bloomberg has a really nice uncertainty index, which is ramped up dramatically. So, this is imparting risks to the soft landing. It looked like the Fed really low probability event, but had nailed the soft landing in this trade war. I think puts the Fed in a very difficult position and certainly increases risks to the outlook.
Hey, Mike, appreciate your time. As always, sir. Michael Darda there of Roth MKM and Partners on the latest. On that survey data, another few reads of consumer confidence later on this week at a time where Chairman Powell seems to have poured some cold water over recent reads. Over
the University of Michigan survey, simply because it's unreliable. It's just a couple people. He wasn't saying that back in 2022. But how much do these sentiment surveys keep on taking a sort of disproportionate amount of market interest?
Changed his mind on you, Mitch, right?
I think so.
Yeah,
I think
pretty
he doesn't
quickly.
Really care.
Yeah.
At all.
Okay.
Until he does.
Until he does. Precisely. It's so annoying, isn't it?
And then it'll be the key metric again.
Up next on the programme, Deepak Puri of Deutsche Bank, Henrietta Treyz of Veda Partners, Norman Rule of CSIS, and Sharon Miller of Bank of America. From New York, the second hour of Bloomberg Surveillance. Up next.
The next couple of months is going to be a really rocky road.
We are at an unprecedented level of uncertainty.
Gold is a perfect manifestation of policy uncertainty.
The uncertainty effects are much worse this time than they were in 2019.
It's almost impossible for me to say, we've seen the bottom, we can break out of this trading range, and it's time for us to add.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now with equities near session highs. Your scores look like this. On the S&P 500, higher here by more than 1 full percentage point. On the Nasdaq 100, bouncing back as well. On the Nasdaq, up by 1.3. The hope, informed by our reporting here at Bloomberg, is that we can avoid a barrage of tariffs next week and that maybe April 2nd, so-called Liberation Day, will be a targeted day.
And so this is enough to release a little bit of that sigh that people have. What this shows to me is, A, there are still people lined up to buy U.S. equities. At the any sign of good news, even if it is just noise right now, and we're not getting a lot of details. And B, there is a structural change where suddenly people are saying, has the tantrum of is the end of American exceptionalism here over? And are we going back to, wait a second, there might still be value here?
So next week might be Liberation Light. The only thing I will caution is Donald Trump cares about the 10 to 15 countries, as Scott Bessent called them, the dirty 15. We don't know how harsh they're going to be on those 10 or 15 and the retaliatory measures those countries may take and the domino effects that may have on global trade.
We're only one headline away, one Truth Social post away from this market getting completely whipsawed the other way. We're at the mercy of the thinking of one individual, and that one individual can change their mind. And we said this earlier on this morning. This is a snapshot of where the administration might be right now. But things are very fluid and can change between now and a week away.
Which is the reason why I asked the question last hour, who is behind some of these headlines? Is it sort of the economic wing of the White House advisors who are saying, OK, we need to address some of the weakness and some of the calls that we're getting from some of the corporate executives? That, to me, is a real question.
Big week of economic data coming up. Consumer confidence later this week. We'll get 2 reads of that. The survey data has been really soft. It's been weakly, so let's put it that way. Will the hard data follow? How much weight will this market put on another read of consumer confidence that reads absolutely dreadfully in the ways that they have done over the past few months?
Deutsche Bank saying that we're likely to see more of the same this week, in that hard data are unlikely to yet reflect the same degree of weakness as the sentiment data. And that, I think, is what a lot of people are counting on.
I go to the C-suite. This is what Mohamed El-Arian told us when we saw the spiral when it comes to inflation on the way up. What is happening now with consumers? What is Nike telling us? What is Target telling us? What is Dick's Sporting Goods telling us? What are the airlines telling us? They're taking a bit of a pause, and they're not going out and spending as much.
It's a wait-and-see economy. Wait and see. We'll see what happens. Coming up in the next 60 minutes or something, the next hour, we'll catch up with Deepak Puri of Deutsche Bank, with stocks pushing higher. Henrietta Treyz of Veda Partners as Democrats muddle through an identity crisis, and Sharon Miller of Bank of America on why small business uncertainty is on the rise. We begin this hour with stocks higher on reports of a more measured tariff rollout than expected. Deepak Puri and the team over at Deutsche Bank writing, we believe that the US equity market could move higher in a 3 steps forward, 2 steps back pattern this year. After the recent setback, we scaled back our S&P 500 target to 6,300, still implying double-digit upside from here. Deepak joins us now for more. Deepak, good morning. Good to see you.
Good morning. Nice to see you.
Liberation Day. What are the team expecting April 2nd?
Well, I think you need to establish the base cost of trade and tariff on the economy. And what I mean by that is, what is the impact on slower growth and higher inflation from the trade and tariffs? And I think the Liberation Day might give us some insight in terms to what that cost is going to be. As you said, I don't think it's going to be concrete. I think it's a moving target. I think it's a fluid story. So you really can't make too much out of it. But I think it is a pivotal moment in this first 6 months of the Trump administration.
Typically, it might be considered as a day where we can move by peak uncertainty. Move past it, that after April 2nd, it can't get a whole lot worse than this. Stocks start to move higher. Pittsburgh Academy and others have made the point over the last week or so that perhaps that's the moment we actually get the certainty and realise the economic consequences of it. And the rally that you've seen abroad, in Europe, in China, tells you that the moves we've seen in equity markets haven't really been about tariffs. They've been about other things. How much weight would you put on that argument going into next week?
Well, there is some credence to that. I think overseas, the markets have really been going up for a whole host of reasons. And I think the overseas markets are screaming in terms of pay attention, U.S. investors, to us, because we have had such a strong home bias over the last decade or so. Having said that, I think trade and tariff cannot be taken lightly, just because it has a very amplified impact to the real economy. And it might take a while for us to get grasp of that. So I don't think April 2nd means that it's a shelf life and there's a time point where after that everything is hunky-dory. I think it might take a while for us to really get a sense of what the impact is going to be.
What do you make of Mike Wilson's argument that actually some of the damage that we've seen to the dollar will help U.S. companies boost their earnings at a time where it's been sort of a headwind over the first quarter?
Yeah, I mean, it could and it should, potentially weakening dollar, given that the S&P has 40% of its revenue coming from the overseas market. The translation effect should help. But then you also have the trade and tariffs, the impact, which in our mind can easily subtract another 1 to 2% from the earnings. And actually, when we revised lower our target from 65 to 6,300, one of the main reasons was the earnings for this year and next. So we revised lower from 275 to 270, and then from 303 to 295 for next year. So I think it plays both ways, Lisa. The other thing that we haven't really seen yet, which I think might be positive maybe in the second half of the year, with the deregulation story. That we haven't seen too much of, so I think that could also have a positive impact on M&A, on animal spirits, which would help the overall complex.
How much do you see this as a zero-sum game, where there's a ball of money and it's shifting from place to place, and it had been in the United States with exceptionalism. Now it's shifting to Europe and to China with the promise of fiscal stimulus and possible reform. Do you see it that way, that it's sort of one or the other at the expense of the other?
Not really. I think you can have, stimulative measures. I think what the market, especially the service, BOA survey that's just came out, is suggesting that you're seeing a lot of inflows into European equities, actually at the fastest pace since 1999. So that tells me it is really the changes in the fiscal policy, the monetary policy, that's really making investors take notice of Europe, of Germany, and putting money in. China is going through its own host of policy action that's been really positive. I think I wouldn't really make it a point that it's because of the lack of U.S. exceptionalism. I think it's just that the other countries have started to get their act together.
At what point is this idea that everyone's exceptional because everyone's spending money challenged by the fact that someone's got to pay for it? And at a certain point, you have to imagine if this does continue, bond yields are going to respond. Do they hamper that? Indeed. And I think that's where you want to be very closely focused on what the rates market is telling you. The fiscal, capacity that a country like Germany has is completely different to where we are in the States, right? So Germany hasn't had this kind of fiscal stimulus that they are planning for. Unheard of, right? You're looking at close to €1 trillion, so 500 billion of the infrastructure fund, which includes decarbonization and infrastructure, then defense spending, which might be another 400 billion euros. So you're looking at a $4.3 trillion economy that might have €1 trillion of input over the last 10, 12 years. From our estimate, that's going to increase their GDP on an annual basis by around 1.5%. That is quite meaningful. I don't think at this stage in the U.S. we can afford that. We have just had a post-pandemic, a byproduct of all that stimulus in case of with unintended consequences. I don't think we can go that route. So I think there are certain countries that have a much bigger capacity for fiscal change, and you're seeing that happen, which I think is positive for global investment. The other thing I would say is there is a rate-cutting cycle globally. ECB at 2.5 deposit rate, inflation at 2.3%. It's only slightly restrictive, compared to where the U.S. monetary policy is. You look at the 4.5% upper range bound Fed funds rate and our inflation rate. We are much more restrictive in a way. So both monetary and fiscal policies making European countries, especially Germany, take notice.
Do you think there's still more upside when it comes to, say, German equities?
I would say a little bit more, but a lot of the easy money, quote unquote, has been made. When you look at when it started ever since over the last 3 months, you've seen the multiple for Eurostoxx 50 and both for DAX gone up 2 percentage points. So 15 times earning to 17 times earning. Historically, there's always been a discount vis-a-vis U.S. equity markets, around 20%. Right now, that discount is 30%, and it's coming from 35, 40%. So I think the underperformance gap has been reduced, But I wouldn't be surprised that this continues for a while before you really start seeing a catalyst for U.S. equities to start bridging that gap.
You might have to look through some pretty weak economic data out of Europe in the meantime, anticipating a bounce back in German growth at some point in the 26, 27 kind of time frame. In 2025, when the tariffs really start to hit, Europe's going to feel it. China's going to feel it, without a doubt.
And it's going to feel it on top of an economy that already wasn't very strong. But people seem to have been discounting that effect because they've been blinded maybe by some of the fiscal promises and currently a little bit better than expected data that's been coming out of the region.
Deepak, appreciate your time as always, sir. Lots to talk about right now and think about. Deepak Puri there of Deutsche Bank. With an update on stories elsewhere this morning, let's cross over to Yahara Hackers with your Bloomberg Brief. Hey, Yahara.
Hi, John. President Donald Trump's incoming wave of tariffs is poised to be more targeted than originally expected. Sources telling us here at Bloomberg the president's upcoming Liberation Day tariff announcement, set for April 2nd, is set to exclude some countries from widespread reciprocal tariffs. U.S. and Russian officials are meeting in Saudi Arabia for closed-door talks. This follows discussions between American and Ukrainian teams the previous day, which Ukraine called productive and focused. The talks aim to achieve a ceasefire in the war and, according to officials, may lead to discussions on the line of control and permanent peace. And on Sunday, Pope Francis made his first public appearances since being hospitalized more than a month ago. The pontiff was discharged from Rome's Gemelli Hospital and returned to the Vatican after thanking crowds that gathered outside to see him. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the programme, the fractured Democratic Party.
Look, I'm not stepping down. I knew when I cast my vote against against the government shutdown that it would be there'd be a lot of controversy. I did this out of conviction. Our caucus is united in fighting Donald Trump.
That conversation up next with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. Equity futures positive here. Session highs up by 1.2% on the S&P 500. On the Nasdaq 100 up by 1.4. The hope, and I stress the hope because things can change, it's informed by our reporting here at Bloomberg that maybe we can avoid a barrage of tariffs next week and perhaps things are more targeted, according to people familiar with the matter, as these tariffs come together on April 2nd.
What's interesting to me is that the Nasdaq 100 is leading after falling, actually underperforming the rest of the complex for a number of weeks now. Does this mean that people feel a sigh of relief? If it's less than expected, we can go back to the U.S., that the tech sector won't be as sort of affected or retaliated against, considering that the Dirty 15 still include China and the European Union?
Let's go back to Michael Hartnett of Bank of America. Let's sit on that quote from him. DeepSeek and Doge have been a much bigger Wall Street driver than tariffs in Q1, but April 2nd is now infecting the global data. China and Germany, stocks there up 20% or so since the US election, and a monster equity amount of inflows, say no one really believes that the trade war equals a recession and a bear market. Have we really been trading on these trade tariffs? That's been the discussion throughout the weekend in the notes that I've been reading going into next week.
And a lot of people say not really, because if you were just trading on tariffs, the reaction in markets would be slightly different. There are pockets of it. But if people really were looking at that, why is it such the opposite of the trade last year when the rest of the U.S. was supposed to catch a cold when the U.S. sneezed? Suddenly that was not part of the equation.
Futures right now up 1.2% on the S&P, up 1.4% on the Nasdaq. Under surveillance this morning, the fractured Democratic Party.
Look, I'm not stepping down. I knew when I cast my vote against against the government shutdown that it would be there'd be a lot of controversy. I did this out of conviction. And look, in my caucus, we have a disagreement as to, some people voted one way, some people voted the other, but we've all agreed to respect each other. Our caucus is united in fighting Donald Trump.
So here's the latest this morning. Democrats calling for Senate Minority Leader Chuck Schumer to step down after he voted for the GOP spending bill. This is Senator Bernie Sanders and Progressive Representative Alexandria Ocasio-Cortez drew tens of thousands for their Fighting Oligarchy tour. Polling showing the party with a historically low approval rating. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, welcome to the program. Just where does Schumer stand now?
Well, John, Schumer's remaining defiant amid these growing calls for his removal and the stark criticism that's coming as it appears that Democrats are divided over how exactly to counter President Trump's agenda. Take, for example, the government shutdown vote, which is leading to all of this criticism. Schumer aides at the time told us they knew this was a lose-lose situation because on one hand, they wanted to negotiate those firmer spending guardrails with the White House, but they knew that they could be blamed for a government shutdown amid so much economic uncertainty, particularly when it comes to our federal workers. And we have to keep in mind that President Trump up to this point has enacted much of his agenda unilaterally, and congressional Republicans have set up the next big agenda item, the fiscal agenda, those tax cuts, to be passed through reconciliation, which means that they only need a simple majority. So Democrats aren't going to really have the chance to engage much when it comes to those negotiations. We should put into perspective, Chuck Schumer's not up for re-election until 2028. And at the moment, there's no Democrat openly vying for his top leadership post. And that would really need to happen before we have serious conversations about a potential change in leadership at the top of the party. But we should just note that there is going to be a heightened focus on the midterms as we see grassroots groups start to put out that they are going to challenge Democratic incumbents with progressive challengers. But John, it's going to be a tricky math game here, and Democrats are going to have to tread carefully in some respects because, for example, in the House, there are currently 13 Democrats that represent districts that President Trump won. They're going to have to thread the needle in areas like that, considering there are such slim majorities.
Tyler, let's talk about the math. 2 weeks ago, NBC polled just over a quarter of registered voters, 27%, say they have a positive view of the party, the Democratic Party. Just 7% say those views are, quote, very positive. How much work do they need to do to close this gap?
Well, at this point, it's appeared that Democrats have sort of struggled with exactly how they want to counter the Trump agenda. First, we heard that it was going to be against President Trump's policies, but then we started to hear it shifting towards Elon Musk and those DOGE efforts. At this point, we're starting to see Democrats, particularly Senate Democrats, go home to their home districts and hold those town halls, listening to constituents about exactly how they would like to see this move forward. And we have to keep in mind that President Trump won, particularly when it came to his economic plan. And we're starting to hear that rhetoric be folded into the tariffs, these heightened talks about recessions and what it could mean for inflationary concerns. Perhaps that is a part that we've heard some Democrats tell us that they are looking to capitalize on. But up until this point, they are really trying to coalesce around a broader message that can counter President Trump and his agenda.
Tyler Kendall with the latest from Washington, D.C. Tyler, thank you. If you are just joining us, equity market session highs on the S&P 500 kicked off by our reporting over the weekend that maybe we can avoid a barrage of tariffs next week, and that perhaps, according to people familiar with the matter, the effort on April 2nd from the President of the United States and this White House might be a whole lot more targeted. Henrietta Treyz of Veda Partners joins us now for more. Henrietta, welcome to the programme. I'm sure you read our reporting over the weekend. I'd love your opinion on what you made of it and what you're now expecting for next week.
Well, I mean, amazing reporting as always. Obviously, your trade teams are incredible. But I think that the targeted tariff idea is a classic walkback we've seen repeatedly from the Trump administration. It has been our base case that the universal tariff is not realistic and would never come into pass. That has been our position since President Trump rolled it out on the campaign trail. So it's not surprising that certain countries are carved out entirely. I think other product lines are going to be carved out. For example, we already have the lower tariff rates on energy and potash. What I'm watching for at this point is to see which countries are targeted with a more insidious, long-term looking tariff from something like a Section 301 investigation. In particular, I'd point out India as a nation that could be seeing its own Section 301 investigation. We know USTR Greer has been very focused on that country in the past, and that's something that really concerns me, along with the pharmaceutical industry, critical minerals. Once those tariffs come on, they do not come off, as we've seen.
Henrietta, the market might be breathing a sigh of relief because the scope, the net the administration is casting might not be as wide. But when it comes to the actual tariffs and what they would call repeat offenders when it comes to those trade imbalances, might be quite harsh.
Yeah, absolutely. I mean, I don't think it's really understood yet how insidious these tariffs are. Last week in D.C., I met with the trade associations for seed, for example. Their products cross the border 8 or 9 times from all over the globe, whether it's EU or China or Mexico, and they're not even a finished product yet. So before you even get your tomato at the grocery store, the seed that it's grown by has already crossed the borders 8 or 9 times. I mean, these stories are going to start to come out as the tariffs go into effect, and the economic feedback of that multiple round tariff and the complete lack of clarity from the Trump administration about what is and is not, USMCA compliant or subject to Section 301 tariffs. What's in List 4B? Where are those tariffs? None of that is clarified, and I think that lead is going to be months to years in the making.
Are there going to be any tariffs next week that come in on day one, say if Trump decides to use IEEPA?
Yes, absolutely. I very much expect for April 2nd to need to pack at least a little bit of a punch. I think particularly exposed to the EU auto manufacturers. We know that the president has had a very serious issue with them for years now. I thought, and I think everybody should remember how serious the risk of those tariffs were in his first term. So I'm expecting those to be ready to go on April 2nd, just as an example.
Henrietta, there are ongoing hearings with USTR from a number of different trade partners to try to understand the economic scope of some of the proposals, as you were mentioning. The latest 2-day hearing in Washington that's beginning today has to do with ships and ships built in China getting taxed in some capacity, or there to be mandates that some of goods shipped around need to be shipped on U.S. ships in order to avoid certain tariffs. A lot of people point to the fact that this is just infeasible given the number of U.S. ships. What are you expecting to learn economically from some of these hearings that we have underway?
Well, most importantly, I want to see which states come out in support of this, because there's going to be domestic shipbuilding that happens in the United States, and you want to watch what states those are in, which districts, where the ports are, who's going to be collecting the revenue or fees, or who stands to gain from those tariffs. Because I think that's underscoring another reality of this administration, which is that federal spending is about to explode. Whether it's the tax bill that's going to be $5 trillion, exclusively deficit financed, if the Republicans meeting with the parliamentarian this week goes their way. And we are seeing additional spending on defense, immigration, and of course shipbuilding, as you point out, to the tune of $342 billion in the current Senate budget. So there's a lot more spend to come.
Henrietta, as we look to next week, it does seem that the scope is not going to be at large, and we're not going to have the sectoral tariffs. But at some point, will we have those sectoral tariffs, say autos, say pharmaceuticals, that were supposed to be paired with this reciprocity on April 2nd?
Yeah, great question. What I would look at is any Section 232 investigation. So those are sector specific. The steel and aluminum tariffs, for example, are Section 232. We know that the president has the same kind of agenda on things like copper, uranium, lumber, dairy, all kinds of different components that target individual nations to a more extreme account. So watch for the investigation, because as I pointed out with 301, those may take 6 months to complete and hold comment period sessions and all those kinds of things. But once they go on, they do not come off. So the China tariffs under 301 have been in effect for 7 years now and rising. Another piece I think will happen is that we'll say that China is in violation of the Phase 1 trade agreement. They have not committed to they have not followed through on their commitment to buy $80 billion worth of goods from us in 2020 or 2021. Indeed, they were below 2017 levels per the latest Peterson Institute economic review. There's a lot that can change, even if some of these pieces are walked back, which they're just not ready to go on. I would align myself with your previous guest, which is to say there's just going to be a lot more here. April 2nd is not the beginning and the end. It's the beginning, and there's a long way to go before the end.
That's not going to be music to the ears of equity market bulls this morning. Henrietta, thank you. Henrietta Treyz there of Veda Partners. This could go on and on and on, based on those comments at the end.
Start of a conversation with a lot of these countries. Potentially, we are still going to be in negotiating mode this week as well as after April 2nd. So this could go on for weeks, and this can go on for months. And as we've been saying on this program a number of times, uncertainty is a feature, not a bug, of the Trump administration.
At the moment, some relief. Equity futures near session highs, up by more than 1 full percentage point on the S&P 500. Later on this week, another read on consumer confidence. You'll get 2 reads on that through the week, climaxing with you, Mitch, consumer sentiment at the end of the week. Just how awful are things for consumers right now? Based on the sentiment surveys, pretty dreadful, but you're not seeing it in the hard data just yet.
So can you dismiss it? And that's been an ongoing conversation a lot of people will continue to have.
Up next on the programme, Bloomberg's Trey Trudeau on the auto sector, with BYD set to report earnings in China. From New York, this is Bloomberg. Equity session highs up by 1.2% on the S&P 500, on the Nasdaq up by 1.4, 2 hours away from the opening bell with some morning movers. Here's Yahira Hackers. Hey, Yahira.
Hi, John. We start with a big mover, and that is 23andMe. It's down nearly 40% now after the genetic testing company said it has filed for Chapter 11 bankruptcy protection. Plus, it also said its co-founder and CEO and one of the biggest names in tech, Anne Wojcicki, has resigned. Next up, we have AZEK. That is an American home decking company. It's up nearly 20% on some M&A action. James Hardie, which sells building materials, has agreed to buy AZEK for $8.75 billion. But the CEO of James Hardie was actually forced to defend the deal after its shares plunged in Sydney trading because of concerns that there is just too much uncertainty to place a big bet like this on the U.S. But he says he's focused on the long-term opportunity and not the immediate risks he says are posed by this administration. And last up, we have Super Microcomputers. It's now up just slightly after Goldman Sachs just downgraded the stock to sell. They say the competition in AI servers is only intensifying and that Supermicro's competitors have done a better job capitalizing on the opportunity. So for that reason, they think Supermicrocomputers' market share leadership will decline. But the stock is up nearly 40% year to date, so something to keep in mind. John?
Yahira, thank you. Appreciate it. More from Yahira through the hour. On our radar this morning, Canadian Prime Minister Mark Carney calling for a federal snap election on April 28th, describing the vote as consequential and saying, quote, Donald Trump wants to break us so America can own us.
So can you make a deal with some sort of a feeling that seems to be galvanizing his party? I will just say it is a good time for him to call a snap election, considering how much sentiment has shifted away from the Conservatives toward the Liberal wing in Canada. And that seems to be what he's doing. Suddenly, he has a real chance and a likelihood of winning this election.
In January, the Conservatives had a 20-point lead that, whether it's through the rhetoric, through it's the tariffs that have really brought the Liberal Party together and more of Canadian constituents backing the Liberal Party. So now he has a better shot because of the Republican in the United States, Donald Trump.
The former Prime Minister Trudeau, tremendously unpopular at the same time. So I think him getting out of the way, there's a relief rally for the party if the party was a stock. But I'm totally with you. We brought this up with Ambassador McMullen in the last week or so. It's kind of surprising to me, and it just works against what this administration here in the United States wanted to work towards too. You would have thought that a Prime Minister Poilievre alongside a President Donald Trump could have created a North American powerhouse with energy and energy abundance at the epicenter of it, and now they're going to have someone that's probably not willing to work with them. Based on the polling at the moment, things are a lot tighter than they could have been.
This goes to the ultimate question of what was the intent here? Was there some sort of collective intent to create something like a trade union, like what Nouriel Roubini was talking about with Mexico and Canada?
What we had talked with Ambassador McMullen about is this idea of potentially conservatives in both countries. And this is what the Alberta Premier had said to Breitbart, that she was trying to get the administration to pause the tone, pause the rhetoric, pause the actions on tariffs to potentially help the Conservatives get into power. And actually, it's backfired.
And not everyone can do what Germany is doing. What I mean specifically by that is the amount of fiscal easing you're about to see in Germany. They have the willingness to do it. They have the ability to do it. I'm not sure Canada and Prime Minister Carney can make the same bet. That's the problem Canada's got right now. This tit for tat doesn't serve them well either. And what you could see in the economic data in the months to come in places like Canada could be absolutely dreadful. And we got a taster of that in the last week.
With the economic sentiment among small businesses in Canada is absolutely plummeting. And it speaks to this question of how quickly is this going to trickle out where other economies other than the U.S. feel it even more than what's happening in the United States of America.
Let's take it back down to Washington, D.C. Senator Chuck Schumer saying he won't step down even as fellow Democrats turn up the heat. Schumer facing backlash after voting for a recent GOP-led funding bill that averted a government shutdown.
And when you look at Polymarket, will Schumer remain minority leader through 2025? Overwhelmingly, 77% say that's the chance he will remain. But I will say this, tons of rumors and chatters that when he's up for re-election in 2028, potentially Congresswoman Alexandria Ocasio-Cortez could be eyeing his seat. It annoyed Bernie Sanders so much over the weekend that when he was sitting down with ABC and was asked about this, he got up and he said, I'm not doing nonsense. I want to talk about real issues. But this is something that is definitely definitely percolating in the Beltway and potentially in New York.
It highlights a schism that's happening right now in the Democratic Party that is going to be an ongoing issue, especially ahead of any further election. Who has the gravity of power? Does it end up with sort of more centrist Democrats that have been in Congress for a while, or will it be the AOCs of the world? And you saw that with rallies over the weekend, and you saw that with Chuck Schumer saying, look, we just didn't have the leverage, and there isn't necessarily the ability for us to do this, and this is my job, I take the fall. This is going to be a schism that they're going to have to reconcile before the next election.
Agree or disagree with the economic policy proposals coming out of the oligarchy tour? Agree or disagree? Why are they popular? They're popular, I think, because they're focusing on economic policy. They're not focusing on identity politics, which is something the Democrats have really struggled with now for a number of years.
Bernie Sanders constantly talks about economic policy. He said, though, I'm in my 80s. I'm tired. I'm a senator from Vermont. But he's drawing crowds of people because he's talking about economic issues, which he has always talked about.
Bernie Sanders filling some big stadiums. Let's turn to this story. A US delegation led by Second Lady Usha Vance is heading to Greenland later this week as President Trump continues to discuss purchasing the nation. White House National Security Advisor Mike Waltz and Energy Secretary Chris Wright also part of the group.
So when it comes to the Second Lady, she's going to, I think, also be going to a dog sledding event. So many people are looking at that and they're like, OK, we can get on board with that. I'm talking about individuals in Europe. But then you hear that the National Security Advisor, Mr. Waltz, is going. And then also Chris Wright, the Energy Secretary. And you think, wow, maybe there's actually more movement behind Donald Trump's rhetoric about wanting to acquire Greenland. The sense I got from Mark Rutte 2 weeks ago in Washington, D.C., the NATO Secretary General, was that he's not envisioning a future where he needs to get involved in two NATO countries going back and forth with each other. But clearly the U.S. sees this as strategic, and they're going to be making more trips there.
Style versus substance. I think we can critique style all you like, because this is kind of bizarre, right? This has come from nowhere for many people. Substance really has refocused the minds on the geostrategic importance of that part of the world. This is coming up in conversations now in many ways where it really wasn't in the last several years and perhaps should have been.
This is true. My question is, and I was trying to figure this out over the weekend, what could the U.S. do if it, let's say, owned Greenland that it can't do now? Because it has a lot of sort of power over that region with respect to a base, an army base there, as well as the right to engage from there. So there just raises a question, what would be gained by taking it over in some capacity?
I did ask someone this. Whatever you have in mind, the administration, but what you want to do with Greenland, why can you not do it within the framework of NATO? And they said, well, that's bureaucratic and it'll take years. So I think for them, it's about speed.
Got some earnings to talk about as well. Those numbers just dropping just moments ago. BYD reporting after announcing new cars and chargers that power up in just 5 minutes. Bloomberg's Craig Trudell joins us now for more. Craig, at first look, it looks like an upside surprise. What do you see and what were we expecting from this company?
Yeah, I think what we're seeing from the company is a beat both at the top line and the bottom line. And as you alluded to, I mean, this is a company that not only is coming off a really incredible year, but it is adding to the momentum with real, tangible progress on product and innovation, maybe of the sort you would have expected to see from a company like Tesla years ago. You're seeing that from the Chinese now. And I think, with BYD's announcement last week of 400 kilometers worth of charge in 5 minutes, with Xiaomi really gaining momentum in China, and they're out today with plans to raise more than $5 billion to fuel their EV expansion. You're just seeing the Chinese competition for Tesla just sort of going from strength to strength here, and we're seeing in these BYD numbers actually. Them retaking a lead over Tesla in terms of annual revenue. So just real strong numbers out of China and out of the companies that are sort of, taking the fight to Tesla in that market.
Craig, for a long time, we said the US innovates, Europe regulates, and China imitates. I'm not sure that works anymore. China has been at the cutting edge of technological advancements that we've seen announced now for the last several months. Craig, and we're seeing that again with BYD, with the developments that we've been talking about regarding the fast charging and the immense range that these vehicles could have in the future as well. I've said repeatedly, Craig, and I know you have as well, that this is the most competitive market on the planet, the auto market in China. Is Tesla getting squeezed, or can they compete there?
I think even Elon Musk would say and has said that this is the most competitive. And, I think he still, has articulated this belief that Tesla is still ahead of these companies, and yet that's where his competition is toughest. But when you look at what BYD has been doing the last few years and the lead that they've built in that market, the momentum that they're managing in Europe, even in spite of the tariffs, I think it is still the case that this is a manufacturer that is highly reliant on its domestic market and is having some challenges with growing overseas. But we are seeing here in Europe, BYD really continue to grow in spite of the fact that they are getting hit with higher tariffs. We've seen those tariffs really slow some of their peers, some of their Chinese compatriots, but BYD is really continuing to grow in lots of markets across Europe.
Craig, is BYD's vision a little bit more too good to be true than it is actual reality? And I ask this with respect to their promise of selling cheaper cars with chargers that can power up cars in just 5 minutes. Are these things safe? Are these things viable on a mass production scale?
I think that's a really important sort of set of questions to raise. And, of course, we've seen over the years, automakers stage these events where, everything is sort of set up just right, and these are effectively stunts. I will say that, BYD does have a sort of track record of not necessarily getting out over its skis and over-promising and under-delivering. There's also questions, as you allude to, of is this the type of charging you want to be doing, routinely and regularly? The answer to that is probably not, but that applies to electric vehicles on the market today, that you use these superchargers, or BYD would refer to it as flash charging. You use them when you absolutely need to, when you're on a road trip and you don't want to spend 30-40 minutes or more waiting to power back up. But for the most part, I think EV owners are living their lives in a way where they don't necessarily have to use these quick chargers all the time. If you can charge overnight, it's better for your battery and better for the longevity of your vehicle. But there are a lot of sort of caveats and questions that we're going to have to sort of tease out just how big of a deal last week's announcement was.
Craig, it was over a decade ago, but in 2011, Elon Musk told Bloomberg Television that BYD as a company has pretty severe problems in China, and he thinks that they need to focus in on China and make sure they don't die there. Well, actually, BYD is not dying. They're thriving right now. How does Tesla respond to this?
I think, one of the things that Tesla, has really sort of dug in its heels on is this idea that, a narrow and really, small focused lineup is sort of the way to go. And I do think that you have to sort of second guess that strategy, given the lead that BYD has jumped out to. How many more models BYD has to offer, how much more diversity they have in their lineup, and how much more affordability they bring to the table. There are a half dozen models that you can buy from BYD that are, substantial discounts to the cheapest Model 3 that you could buy in that market. And, there's a real question of just how much Tesla can compete. Will they maybe stick to this in the sense that, perhaps they can, be more profitable or stand a chance of greater profitability by sticking to this more premium strategy? Perhaps, but that means giving up some real growth, and that is only going to sort of feed into this broader trend that we've been seeing from Tesla, which is on a global basis. This is a growth company that is no longer growing.
Hey, Craig, appreciate the update, sir. Thank you. Craig Trudell there of Bloomberg on the latest with BYD, a beat on the top and bottom line from that major car manufacturer out of China.
At the same time that we've seen misses from Tesla with respect to deliveries and particularly the performance in China, it just goes to the question that you asked, the sort of, innovates, regulates, and then over in China imitates. How much are we seeing true innovation in China, like what we're seeing this morning from Ant Financial potentially, that challenges what we see in the United States in a significant way?
And an industry that benefited from massive barriers to entry over the last several years, which is an argument that some officials in this administration here in Washington might make the argument
that if you have this idea of potentially increasing those barriers, that might be helpful to ours or potentially could stymie some cross-pollination. Honestly, these are ongoing conversations, and I don't have an answer to them.
Force people to manufacture there, force people into joint partnerships. There was always the accusation they were taking their technology to get a foothold, and here we are. They're making advancements, and I think that's the real development out of China. We've talked about imitation for a long, long time in that country. Now they're making these technological, value-added advancements in a way that you'd expect to come from the United States. They're coming from somewhere else.
And I think China has a long-term view. When it comes to the batteries, they own the entire supply chain, not just 80-90% of the raw materials, but the processing of those raw materials to make the battery. Their long-term view, I believe, is you can't just buy our batteries anymore if you're Tesla or someone else and want, say, even a five-minute charger battery. You have to buy the car, and we will be Detroit for the world.
Geopolitically, that makes the rest of the world incredibly vulnerable as they push towards net zero and the green efforts of the last decade or so. Now, you can make a climate argument for that. Of course you can. Can you make an international relations argument for that? I think things become a little bit more dicey on that front.
So this really goes to the whole how much, if there is a big barrier, does China sell cheap goods into the rest of the world that much more? I will say to your discussion, though, to your point, it's a really interesting one, that if China benefited from getting some U.S. ideas by forcing them to bring factories there, is the U.S. going to miss out on getting Chinese ideas if those barriers are up in a significant way?
That's the latest on BYD. Let's get the latest on stories elsewhere. With your Bloomberg Brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Israeli airstrikes killed 2 members of Hamas's acting cabinet on Sunday. The once 20-member governing body now has just 9 remaining living officials. Hamas confirmed the deaths, saying they were among hundreds of fatalities from the new Israeli military campaign that followed the roughly 3-month ceasefire that expired earlier this month. And on China, Chinese Premier Li Cheng says China is ready for shocks as the world prepares for President Donald Trump to announce more tariffs next month. He told foreign business leaders gathered in Beijing on Sunday that countries should open up markets in the face of growing economic fragmentation. And U.S. officials asked Italian egg producers if they can ship product to the U.S. amid shortages ahead of Easter and Passover. Italy's Egg Producer Association head was surprised to hear the request and, quote, thought he was on candid camera. This comes as the U.S. experiences its worst ever bird flu outbreak, hurting supply. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, a feature, not a bug.
This amount of uncertainty is not the bug of this where we are in the cycle. It is the feature of the cycle, and we just have to learn to live with it.
Up next on the program, we'll catch up with Sharon Miller of Bank of America, live from New York. This is Bloomberg. Equity futures session highs on the S&P 500 up by 1.2%, on the Nasdaq 100 this morning. We're positive by close to 1.5. Under surveillance this morning, a feature and not a bug.
This amount of uncertainty is not the bug of this where we are in the cycle. It is the feature of the cycle, and we just have to learn to live with it. A lot of consternation about what happens on April 2nd. Indeed, April 2nd is going to be a very important day. We'll know a lot. But we also will not know a lot. It's a start. It's not the end of the resolution. It's not the end of the uncertainty.
So here's the latest this morning. The companies on the front lines of policy uncertainty. Bank of America publishing its newest small businesses checkpoint. The team writing the following. Despite continued optimism, small business uncertainty is on the rise. According to aggregated credit and debit card spending data, small businesses are slowing their card spending across the board. Sharon Miller, the president and co-head of business banking at Bank of America, joins us now for more. Sharon, good to see you.
Good to see you
morning.
too. Good morning.
Let's talk about the little spots of weakness that we're starting to see emerge. Where are they and what's behind it?
Well, we are seeing weakness in manufacturing firms, especially the smaller manufacturing firms, so those with 500,000 in revenue and below. But as you look at the larger companies, we're still seeing strength there. We're seeing strength in retailers, with the exception of furniture.
Which really shows the sort of ad hoc nature of some of the threats and how different companies are responding to it. Before we dig into the specific sectors, I'm wondering the difference between big and small businesses. You said small businesses are slowing their card spending across the board. Is that the right distinction to make, small versus big?
I would say small versus medium-sized businesses. So when you think of our segment, it's anywhere from startup to 50 million in revenues. So you have small and mid-sized companies within there. But generally speaking, we're talking about $1 million and below company when we're saying smaller businesses.
What's the standout? What industry has been very strong at the moment?
Well, we are seeing strength in retailers, with the exception of furniture, but restaurant spending is strong. We are seeing strength in, shopping, going out to eat, all of those types of retailers, e-commerce. So I think that there's some trends there. And so you have to see what the data is telling you, not necessarily what the consumer is telling you.
Is this a leading indicator? Are these card data tending to point to strength or weakness depending on where we are in the cycle?
Well, I think it's a wait-and-see attitude. I mean, there are things on the horizon and some dependencies that businesses are thinking about, whether it's tariffs, the political environment, taxes. How is all that going to come to life as they're thinking about CapEx for their business?
Let's sit on CapEx. How do you get a decent idea of whether those CapEx decisions are being delayed, pushed back, or just totally derailed? Which one do you think it is at the moment?
I think it's delayed. I think it's a wait-and-see attitude where you're still seeing people spending on their business, albeit not as strong as we had seen last year. So there is some wait-and-see out there because they don't know what's going to happen. And so as I'm talking to clients around the country, that's what I'm hearing as well. We do want to expand. We do want to invest in our business, but we're holding off just a bit to see what's going to happen.
Sharon, as you know, these companies have a massive role to play in employment in this country. And we're starting to focus even more on the hard data, the employment numbers that come in every week, jobless claims. Now, if you go into a wait-and-see economy, how long before you start to say, we're not going to hire, we're going to fire? Is there a lag time? Is there a typical framework timeline to think about this, or are we in no man's land?
I wouldn't say we're in no man's land. I mean, we've got to watch the data every week, every month, and what's happening in the economy. But I would say that in business formation and those that are actually putting together plans to hire businesses, we are seeing an increase in the number of new businesses opened that are talking about, I'm going to employ people. And so that is good news as you think about where we are today versus, pre-pandemic levels.
Are there significant exceptions? We were talking about sort of the ad hoc nature of who gets hurt and who doesn't. Are there areas, small pockets, where you are seeing real deterioration?
I would say we are seeing a little bit of deterioration in manufacturing, especially in those firms less than 500,000 in revenues. In furniture, that's the only retail category that we did see a decline. And so those two areas are areas that we are watching.
I find the retailer point absolutely fascinating, and I think it reinforces what Chairman Powell said just last week, that you can read too much into the sentiment survey data to look at what people are doing. And right now for him, for many, for economists too, they're looking at the hard data and it's still holding up, and there's not much to see here.
When you take surveys online, there have been studies that show that people tend to say that they feel less good. And a lot of these surveys are online. And so they all rant online. I feel terrible. Why? And then they say, oh, I'm going to go shopping. And this is sort of what has been bearing out.
Retail therapy.
Exactly. In the data.
That sounded personal, Bramo.
I'm just saying, it's always, those texts that you send to people where you're just ranting and then you're like, okay, now I'm done and I move on.
Is that how people approach you, Mitch, when it comes out on Friday?
You want my opinion on the world? Pretty much.
Sharon, it's good to see you, as always. Thanks for being with us. We appreciate the update. Sharon Miller there of Bank of America. Up next on the programme, Jean Boivin of BlackRock, Dana Telsey of the Telsey Advisory Group. We'll catch up with Kathy Bostjancic of Nationwide and Troy Gayeski of FS Investments. The third hour of Bloomberg Surveillance up next.
At some point, we know some kind of direction where this administration is going.
Most investors we speak with are not baking in tariffs.
I don't expect that the inflation effects of the tariffs would meaningfully last beyond this year.
Each tariff is a one-time hit to a price level, but the effect on growth is probably much more long-lasting and significantly more consequential.
The projections for growth are not consistent with a pro-growth president's agenda.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now with equity futures near session highs on the S&P 500. Your scores look like this on the S&P, up by more than 1 full percentage point. On the Nasdaq 100, higher by close to 1.5. Perhaps we can avoid a barrage of tariffs next week. That's according to our reporting over the weekend here at Bloomberg, that maybe the April 2nd Liberation Day effort might be very targeted. We'll get another read on how people feel about those tariffs later this week. Consumer confidence. We look to you, Mitch, to see how people feel on Friday.
Yeah, do we? I guess that's the question, because Jay Powell sort of poo-pooed that as being a major metric, considering that it hasn't complied with some of the forward hard-looking data that we keep getting. That said, at what point will the soft data catch notice and catch stock investors to take notice? Because right now, people seem to be pricing in volatility, not necessarily any kind of economic downturn.
It's a fluid situation. And next week, ahead of April 2nd, I think we need to remember what we've heard from officials saying that they're currently in negotiation mode with some countries. And maybe the tariff barrier won't be as high if they're coming in with a deal and saying, we're going to lower our threshold if you don't come out and hit us aggressively on April 2nd. I think one caveat, maybe the scope won't be as big. But when you're looking at targeting 10 to 15 countries that have massive deficits when it comes to the United States, they can be very harsh if you're just looking at 10 to 15. What is the secondary effect, the dominoes of what this can all cause?
How many times have we seen this movie? We get one post by the president, market swings the other way. Is that how vulnerable we are again this morning? Just that one post from the president who says, no, we're going big next week on April 2nd?
To that point, I'm thinking to myself this morning, who trades on these headlines? I mean, really, how much credence can you give them if you really are betting your portfolio? And there are going to be traders that do it on the margin, but I wonder how much other things are playing into this. And you mentioned DeepSeek. And I just wonder, Ant Financial coming out and talking about new technology that could potentially also increase the efficiency of certain artificial intelligence models. Look, that is its own story, and there's a question around how believable it is, what they actually did. Again, how much are some of these other stories driving things and people attributing everything to trade?
Other things going on here. Take a peek, get a cheap ticket for Snow White, sit back for a couple of hours.
You think that's moving the market?
Meditate.
People watched it and then they sold.
I'll tell you what, should move things for Disney. It's brutal.
Did you watch it?
Absolutely. No, I haven't watched it.
You did channel checks,
I watched the trailer. Look, we're anticipating this bombing ever since we had that original press tour. Do you remember with the lead actress a number of years ago?
When the prince was called a stalker 2 years ago?
Yes, and she said it was weird and, et cetera, et cetera. This was always the direction of travel for this movie.
All I can say is I watched Anora over the weekend, and it's a fantastic movie. I'm not going to tell you what happens at the end, but I will say that, honestly.
Can you tell us what it's about?
It's about an exotic dancer.
Okay.
Who speaks Russian.
All right.
Who gets on with a Russian oligarch's son.
Okay.
And what happens then? I think it's fantastic. My point is, it was
what
very
does
original.
Happen next?
Well, I'm not going to tell you. Stop, please.
Okay.
Anyway, it's good, and I recommend it, but it was original. And when are we going to move away from nostalgia to originality? I love it.
Okay. No spoilers.
Shogun.
Shogun. Never forgiven for
Shogun.
Shogun.
I'm never going to bring up movies again.
You will never be forgiven for spoiling.
I didn't just spoil
Shogun.
Adora. I gave the very bare contours of the basic understanding of what it was.
I always get nervous when she starts talking about film.
Session highs in the equity market on the S&P, up by a little more than 1 full percentage point. Coming up on the programme, Jean Boivin of BlackRock on hopes for targeted US tariffs. Dana Telsey of Telsey Advisory Group on the outlook for retail. Troy Gayeski of FS Investments warning investors should buckle up. We begin this hour with stocks higher on reports of a more targeted US tariff approach. Jean Boivin of BlackRock writing, we stay overweight US equities on our tactical horizon of 6 to 12 months as policy uncertainty should ease over the period. John joins us now for more. John, good to see you.
Great to see you.
More confidence being long stocks versus bonds. Just help us understand the why.
Well, on the bond side, I think we are high conviction that
we are observing right now a resetting of global rates higher. It's a big story. I think we see fiscal spending being everywhere. This is in part in reaction to the foreign policy of the U.S., and that has still to play out. So I guess being underweight bonds is high conviction. On the equity side of things, we remain of the view that we are at uncertainty right now is maxed out. Never seen that before. Along many policy levers, objectives are not clear, and so all that together, I don't think can last forever. I mean, that's not good for anyone. So we think over the next few weeks, as we get more clarity, I think markets will be able to get on with whatever is the destination, and that's the overweight.
Markets where? Markets in the United States? What about markets elsewhere that have actually rallied into this decision? I'm thinking of China. I'm thinking of Europe.
Yeah, so I think right now this has been the opposite, right? So we've seen the rest of the world outperforming the U.S., but on a 6 to 12 month horizon, we expect to go back to the U.S. taking the lead. I think this is partly because on the European side, even though we are a bit more positive, we turn neutral. We used to be underweight. We think this is more of a narrow story. It's military spending, it's banks, and it has some momentum for a few months, but we don't think this is yet a macro story that's going to carry Europe for the next 12 months. So we expect to revert back to U.S. taking the lead as a result.
If you put these two ideas together, the idea that we're seeing a structural repricing of rates and that you still are overweight the U.S. or expecting the U.S. to take the lead later this year, do you think overall equity returns are going to be constrained by this repricing of rates globally?
So we don't think rates are coming down. We think the 10-year yield in the U.S., which has been rallying, is not the story we're going to see going forward. So there's going to be an adjustment. But we think that, there's deep forces that will reassert themselves. AI, we still are, very bullish on AI being a powerful source of drivers' returns. And as a result, we think it's possible to withstand higher rates, moderate increase in rates, and withstand those for equity. If we get a very significant adjustment in rates, which is not impossible given the uncertainty we're facing, depending on the policies that will be put in place, then it would challenge the view on equities, I guess, for the U.S.
In the United States, yeah. Do you think that the U.S. is going to be the main beneficiary from this AI megatrend that you've been talking about for quite a while? Or do you think that increasingly you and your colleagues are starting to think about China as also being maybe not as much of a beneficiary, but a significant one with some of the advancements that we're seeing currently?
Yeah, I think both are set to benefit from the AI story. I think both China and the U.S. We think this is where it plays out. There's a bit of a Middle East story as well, but it's not a global story. So we think this is more powerful in the U.S. I think the U.S. eventually provide an environment where we're more comfortable with, I guess, on the macro perspective. So the AI story is playing in both places. I think the macro backdrop eventually is more positive in the U.S. That's why the combination of macro and AI favors U.S. over China for us.
It's interesting you mentioned the Middle East. We just had Sheikh Tahnoon down in Washington and the UAE saying they're going to invest more than $1 trillion in AI. But a lot of that is almost contingent on them being able to get access to these chips. Is that all the leverage the U.S. holds? They have all the power?
I think that's part of it, right? So it's first of all, it's a story that is very, very high barriers to entry, a massive amount of capex that is needed to be a player in that space, and I think so. You need big firm with big balance sheet. It's possible for other countries with deep pockets to play a role in there, but I do think that the U.S. does have the upper hand on this at this stage.
When you see positive news like that, but then you also see banks coming out and potentially raising their probability of U.S. recession, how do you weigh the two?
Well, I think right now the part we haven't talked about, we've talked about the 6 to 12 month horizon with our view that eventually we get back to a better place. But for now, as I said, the uncertainty is kind of peak level. I don't think I've ever seen so much a range of views on what might happen. The commentary on the outlook is as wide as I've never seen. It's as political as I've never seen it. And as a result, that is holding back people. And the longer it lasts, then I think we don't think a recession is in the card. We think there's a lot of resilience. In fact, I don't think the recession is the biggest risk. I think the biggest risk is long-term decision, infrastructure decision, and so on. That if they're put on hold, we're going to see a lower structural growth rate in the U.S. eventually. And that's a much bigger deal than a recession.
You keep talking about how later this year we'll get to a better place from some sort of policy level or from a certainty level. What does that mean at a time when we keep talking about uncertainty being a feature and not a bug of this administration?
I think, I'll give you one example in the tariff. I think, right now there is a debate, there's uncertainty about what will be the impact of those tariffs for the U.S., for the trading partners. And you can make an argument that it's going to be minimal, it doesn't hurt the U.S. Once the evidence comes in, I think the leverage of this bargaining chip will be waning. And so I think one way or the other, we're going to see a reduction. It's going to be harder to dismiss the damage from tariff. It's going to be harder to just make bold statement about we're going to go with even higher tariffs. And I think you're going to see a convergence someplace as a result.
Is that the moment to buy bonds when we actually start to see that? Or is there another reason why you just don't believe treasuries are going to play that role this time around? I
think the underlying forces, we don't think inflation is resolved. I think the Fed last week has painted the most optimistic scenario and they've included that in their forecast on the tariffs.
You don't buy it?
I don't buy it. And then I think the fiscal side, we'll need to see. But we have hope of tax extension coming in. So we know this is going to make the deficit wider if that's the only thing happening. The saving is much more uncertain. And so I think the fiscal story remains one of deficits and putting pressure on yields.
When you open up the SEP and you look at those forecasts from the Federal Reserve, which piece of that jumped up to you and said, that's aspirational, I don't buy it?
Well, to me, the most revealing part of the SEP and the press conference last week was when asked about whether this is a one-off story, inflation. I think the chairman was very careful to say, well, we don't know for sure. Last time it was. But when he answered a question later about when they would get concerned about inflation, he said, well, if we were to see inflation appearing as part of the economy that have nothing to do with tariff, then we would get concerned. That's, to me, doubling down on this is a one-off. They see the tariff as being a one-off, and so that definitely stood out for me.
Do you not think it is a one-off?
I think it could be, but and it was last time because it was very targeted. If we're talking about broad-based resetting of global trade, I think there's going to be adjustment. I think the cost of doing international production will be higher. And it's not just a tax or a tariff. It's the broader adjustment, higher cost of production for some time.
You've heard the argument from economists that because employment anxiety is higher now, the second round effects will be dampened. People won't be able to ask for a raise. You won't see those second round effects of that spike in prices. What do you say back to those people?
I think we have a very tight labor market. I think that the Fed sees it as being balanced. I think we have seen over the last few years immigration playing a massive role in helping the labor market cope with a lot of tightness. I think that is the big story going forward. So I'm not sure that the bargaining power for wage negotiation will shift that much.
Ask for a pay raise. Good news.
Okay,
it's
really? Yeah. Really? You're on a mission. Man, I wonder what
I don't like that psychology shift that shifts away from the, towards the employer. And,
yeah, well, I'm keep fighting it.
Not asking for a bowl of whatever.
Yeah.
It's not Oliver. John Boivin of BlackRock, thank you.
Thank you.
Please, can I have another? Another what?
I know that's
What's he asking for back in the day?
I don't remember. It's just please.
Oliver Twist, can I have some more? All right. Let's give you an update on stories elsewhere. Let's get you Bloomberg Brief. Here's Yahara Hacker. Say Yahara.
Hi, John. The tariffs President Donald Trump is set to announce next month will be more targeted than he has indicated. Sources telling us the president's upcoming April 2nd Liberation Day tariff announcement is set to be more focused and could exclude some countries from widespread reciprocal tariffs. Meanwhile, 23andMe is moving forward with bankruptcy proceedings in the U.S. to help facilitate a sale. The personalized DNA testing company plans to continue operating during the process. 23andMe was valued at $3.5 billion when it went public in 2021. Now court documents show it has more than $277 million in assets and over $214 million in liabilities. And London's Heathrow Airport has defended its handling of Friday's unprecedented shutdown, saying it would not have been able to operate uninterrupted. The statement comes in response to comments from the National Grid CEO, who told the Financial Times there were enough alternative power supplies to keep the airport running. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Thank you very much. Up next on the programme, the Morning Calls Plus, Dana Telsey of the Telsey Advisory Group on her outlook for retailers. That conversation up next, live from New York City this morning. Good morning. The opening bound 1 hour and 13 minutes away. Equity futures on the S&P still near session highs, up by more than 1% on the S&P 500. On the Nasdaq, up by 1.4. Let's get you some morning calls. First up, Goldman downgrading Supermicro to sell, citing AI server competition and margin pressures. That stock is down by close to 0.5%. Your second call from Jefferies, upgrading FedEx to buy, noting the shipping giant is executing on cost-cutting plans. That stock is up by 1%. And finally, Morgan Stanley initiating coverage on General Mills with an underweight rating, seeing a stable backdrop but more secular headwinds. That stock is lower by 0.7%. Let's stick with the consumer. Investors looking ahead to consumer confidence later on this week. Dana Telsey of the Telsey Advisory Group writing, frenetic is an apt word to describe the current environment. Key measurements such as consumer sentiment and volatility in the stock market reflect the anxiety out there. Dana joins us now for more. Dana, good to see you as always.
Nice to see you. Thank you for having me.
Are people pulling back? That's what we want to know. Do you see it in the channel checks?
We are seeing it in the channel checks. When you look at the earnings results that are coming out from retailers lately, the fourth quarter almost feels divorced from what you have in the first quarter and going forward. You look at the guidance that companies are giving out in the consumer space for the first quarter. In essence, we always know the consumer area is a third and fourth quarter weighted. But now the first quarter is expected to be, for the most part, weaker than consensus and what consensus had out there. So you need to accelerate even more rapidly. And that word frenetic, the reason I like it, I looked up the definition, anxiety-inducive activity in a wild and uncontrollable way. And that's what it feels like today.
Consumption has been super resilient for the last several years, but beneath the surface, beneath the headline numbers, it's been very bifurcated. Low-income consumers have been squeezed for quite a while, a number of years now. High-income consumers have held up. Is that still the case? Because if they start to go, this is over, what's the story?
I think the higher income consumers moderated their spending a bit. You look at what Delta Airlines said a few weeks ago, and Delta is the premier airline with a premium price of 20% or more. You're still seeing the Uber high end doing very well. You look at Hermes's results and the double-digit increases. But everyone else out there, it's a state where it's not as robust as it had been. And consumers are discerning. Look at what Costco said, where they've seen a shift to people eating at home. And we're seeing more evidence of that type of behavior. What do you need to win? You need newness, you need events, you need activation in order to drive interest. I was on Friday and on Saturday, I was downtown at the opening of the new Printemps department store, the first one here in the U.S. The wait was around the block. So there's interest in newness.
Do we have a sense then, just to that point, of who might be using this as an excuse? The idea that there's consumer hesitancy, so why not kitchen sink it, throw all your problems out there, clear the decks, and then do what you want?
I think some of the companies overall who have been performing poorly, you're able to do that. You've certainly taken a look at some of the lower-end department stores that have had some of those issues. But many of the others, they're hoping that they can still see that sell-through. The ones that are winning, brand leaders, discounters, and off-pricers. You definitely see even some weakness in some of the luxury brands that haven't been as strong. You look at some of the European brands like Kering, doesn't have the same robust posture that they had before, and they just found a new Gucci designer, so we'll see what happens. It'll be interesting to see LVMH's sales results when they report in mid-April.
Who do you think is going to be really caught in the crosshairs when it comes to tariffs?
The areas that are being impacted the most from tariffs, it's definitely some of the footwear companies, some of the dollar stores. And the speed at which you need to diversify, you can do three things. You diversify to other areas, you split the cost with the manufacturers, and you raise prices. But diversifying and paying the cost with manufacturers or them diversifying, it takes time. There's a reason companies went to China. It's fast and the labor knew what to do, and it's cost effective.
But when it comes to April 2nd, we're going to get this, quote, Liberation Day. Maybe it's going to be more selective than a broad scope. Mm-hmm. How are these companies preparing for that? They're not going to be able to move manufacturing in a matter of weeks.
They're including it in their guidance. For many of the companies, the guidance that you've seen for 2025 includes the tariff implications at the point until which they know how much the tariff is. Anything else, it is basically they'll need to reset again. And for the most part, in the early runnings, you're right, it's not a lot of the apparel world, but it is many of the other areas that raises prices for the end consumer.
So we've heard reports about certain companies, I'm thinking about Walmart in particular, that have gone to Chinese suppliers and said, all right, cut your costs by 10%, eat it. And they say, no, thank you, not going to do it this time. How much are you seeing that across the board, these sort of efforts to jawbone suppliers into absorbing it, not getting that, and so ultimately they will have no choice but to raise those prices?
I'm hearing about it from some of the bigger players, the smaller players also. They're all looking at other areas in which to diversify manufacturing, not in the U.S. because of how expensive it is. Going to South America, going to Africa are some of the other areas that we're hearing companies work to do that.
Macy's has Macy's problems. Their stock is down by another 20% so far year to date. Do we need another luxury department store in New York City? You mentioned Printemps. Do we need another one?
Overall, I mean, the location is a little bit different on Wall Street, but in saying that, there was people down there, certainly when I was there, around the block.
I noticed the same thing down there over the weekend. Yeah. I just wonder if that lasts.
We'll see. We'll know in a month or so, but I think that location is a little bit odd to get regular visitors all the time.
But they don't want to be known as a department store. I think the French are very upset about this. Yes. So how are they communicating that?
5 restaurants.
Hang on a minute. What are they upset about?
They don't. Printemps doesn't want to be known as a department store.
What are they calling it?
Experiential. They want to be experiential
purchasing of items.
They basically have
like
5
a
restaurants.
Selfridges, like a Harrods,
but
right?
much smaller. I mean, when you're thinking 55,000 square feet, it's 2 floors. Not all the restaurants are open yet.
The reason why is exactly because of the way that you asked that question. Do we really need more department stores? You have to wonder. A lot of people are thinking the same thing because Macy's was not a pleasant experience because it didn't really do it well.
Downtown's a bit of a ghost town on the weekend. We got enough footfall down there to make this work?
That's going to be the big question. They do have exclusive brands from France that are there. Since it's hard to get in, it's going to take time for everyone to see it and go back on a repeat basis.
Yeah, I'm willing to go downtown to go see it, especially knowing there's lines, and there's probably even more lines during the week.
They've got one.
Right. Well, I agree. I will go back there to check it out to see how they're differentiating themselves. You would think there was other locations like that Barney's building, but that's much bigger than 55,000 square feet. And you need an anchor to bring people up Madison Avenue.
Oh, the old Barney's building?
Yes.
I used to like it there. It's
empty.
It's still empty, right?
It's still empty.
The one you're talking about, the one on Madison, not the one downtown.
Yes, Madison and 61st.
They need to do something about that, Dana. We'll sort that out. Dana Telsey there, the Telsey Advisory Group. Dana, thank you.
Thank you.
Good to see you. I was downtown. The Beekman was full. Lots of people there having lunch, doing drinks, all of that stuff. Then you go to Printemps, round the corner. The line literally going round the block.
25% of the brands that they're bringing in, you cannot get in the United States. You literally have to go to France to see them. And I've been to Printemps in France, and I love it. So I'm very excited about this because finally you get access to
That's the
brands.
attraction.
I think that's the attraction. Okay. That's how they're going to win, potentially, and maybe the restaurants.
Once you get in.
Yeah, but the experience aspect is important. I mean, I think about that with my own younger cohort of sample size at home, and they talk about the experience of going to certain places and why they are willing to go to the place. It gives you a place somewhere to go. It's interesting.
You're socializing with friends.
Exactly.
Couldn't care less about the experience. Sort of like, I just want a friction-free transaction. Just want to
There's
go
something
in
for
direct.
everyone.
Yeah, I was about to say, if the whole world
I don't
were
want to
you.
talk to people. Just let's get the size and let's go.
These shops
All right?
must really see you coming in and run. I'm the type of person that they offer you some champagne, then I'm buying another blazer.
You're more expensive. That's taking a hit on the margin. I'm just direct. I'm much easier. They see
I want
me
the
coming,
wow of seeing something new. It's very exciting.
Make the sale. Coming up on the programme. Dana, always good to see you.
Thank you.
Thank you. Kathy Bostjancic of Nationwide, Troy Gayeski of FS Investments, Annmarie, who cost them. How much money does it cost before you buy anything? They're like $200 deep.
Yeah, but then you end up buying more.
Yeah, but then she takes out that plastic, and let me tell you.
Just going down there once.
Yeah, exactly.
Yeah, great. From New York City, good morning. The opening bow 60 minutes away. Equity futures positive by more than 1 full percentage point on the S&P 500. On the Nasdaq, we're higher by 1.5. If you are just tuning in and waking up this morning, welcome to the program. There is a reason why equities have bounced so hard this morning. Reporting over the weekend from the team here at Bloomberg down in Washington, D.C., that on April 2nd, that much anticipated Liberation Day, when the President of the United States said he would unveil some major reciprocal tariffs, we understand based on officials familiar with the matter that maybe that effort might be more targeted?
Liberation Day light, maybe, potentially. It's going to be selective when it comes to the countries they care about. But maybe it is those 15 countries, dirty 15, as Scott Bessent, the Treasury Secretary, spoke about. How harsh are the measures going to be on those countries, I think, is the question we need to be asking going into next week.
We should stress this is a snapshot of where the administration is right now, and things can change. And we've used this word repeatedly throughout this morning. Things are fluid. They are always fluid in a Trump administration, and they will continue to be when it comes to things like trade. A busy week of data also on deck. Joining us now is Michael McKee, our economics and policy correspondent. Mike, looking forward to your interview a little bit later with the Atlanta Fed President, Raphael Bostic. What else is in store later this week?
Well, we've got a pretty busy week ahead, John, although it's a little back-weighted towards the end of the week in terms of economic data. Nothing today. Tomorrow, however, consumer confidence from the Conference Board. It's going to be very interesting to see if they track what we've seen from the Michigan numbers. A lot of disappointment among Americans in terms of what's going on. Then we get durable goods orders, and then Thursday we start off with some of the bigger stuff. Advanced trade, we'll see what the trade deficit has done and how that affects Donald Trump's mood. And jobless claims, of course, we watch that every week. And Friday, income and spending and the PCE inflation report, which is, of course, the one that the Fed follows, and we're expecting it to go up a little bit, something we can ask President Bostic about today. And then also you get the final Michigan sentiment numbers. So we'll have an idea of how people feel about inflation and the economy by the end of the week. We'll see if the Fed officials who are speaking this week are going to have any more clarity on what's going on, because we've basically got two a day, like the football training camps, two a day of Fed speakers, including Raphael Bostic today. He'll be joining me at about 1:45 Wall Street time this afternoon, and we'll be talking about things like how do you know anything at this point about which way the economy is going until April 2nd?
Mike, looking forward to getting some more Fed speak this week, and I'll tell you why. When you go back to last week, a lot of attention was paid to an unmoved median dot for 2025. You were the first to point out to me, sent me an email almost straight away saying that look at the distribution of the dots, and they started to skew hawkish. Mike, could you just break that down once again for us and maybe explain just how much daylight there might be between some speakers on the FOMC and what we heard from Chairman Powell in the news conference?
Well, we had two in December. For the December dot plot, we had two people who were above the ideal. In other words, fewer than two this year for the Fed. And now we have 8. So we have a leaning on the Open Market Committee towards not even getting to 2 rate cuts this year. A couple of them say none. And so there's a hawkish, I guess you'd call it hawkish, but it's really sort of a pessimistic view that the Fed won't be able to cut rates anymore this year. And it wouldn't take much to move them in that direction if inflation stays the way it has, or stays sticky the way it has.
Mike, appreciate the update and looking forward to your conversation a little bit later with the Atlanta Fed President, Raphael Bostic. Not many people talked about that hawkish distribution, that hawkish skew that we saw in the dot plot last week.
Yeah, because that was just erased by Fed Chair Jay Powell's transitory word, as well as his idea that probably it's going to be tough, but they will be able to see if the tariff-induced inflation is just going to that particular area. I do think it's important, though, because if you take a look at the center of this committee, they see stagflation as an increasing likelihood, and that is a very, very difficult recipe for the Fed to fight.
Let's stick with the economy. Kathy Bostjancic of Nationwide Mutual Insurance writing, if downside risks to our baseline forecast continue to build, the FOMC may shift its focus from inflation to slowing economic growth and potentially deliver a rate cut earlier in Q3. Kathy joins us now for more. Kathy, welcome to the programme. That is the number one question that so many people have. If the Federal Reserve has sticky and above target inflation, are they in a position to respond to downside risks materialising in the economy? What gives you the confidence that they can do that later this year?
Well, good morning, John. And I should highlight first our baseline forecast is that they don't, that they wait until the fourth quarter and we only have one rate hike for the year. But what I was illustrating is that we continue to see downside risk building, right? You're seeing in the economic data, even if these tariffs, which you're talking about, maybe are more targeted and not as negative for growth or inflation, you still have a lot of uncertainty out there. I think even after April 2nd, it will have a little clarity, but still uncertainty. And that uncertainty is corrosive to economic growth. So my concern is that there's downside risk to our baseline, and that the Fed, maybe they do need to come in the third quarter. Now, they have to balance things, right? Inflation versus growth. But if they believe, now Chairman Powell opened this, the genie bottle, right, and said, let the genie out, said transitory. If they really do believe that, then they can shift to growth because they're going to look through the tariff impact. But, tremendous uncertainty at this point.
Kathy, right now the market's baking in almost 3 rate cuts through the remainder of this year by the Federal Reserve. Do you think that increases the risk of inflation picking back up in the scenario that you just laid out where growth is slowing, inflation is sticky, and some of it or a lot of it can be attributed to tariffs?
Yeah, financial conditions, I think, overall are a bit volatile, and a lot of that due to the equity market, but we're also seeing corporate bond spreads widen a bit, not alarmingly so, but widen. So even though the bond market's pricing in more easing, the fact is I don't think overall financial conditions have really eased that much. And if you look at the 10-year yield, it's quite volatile, but it still remains high. Mortgage rates are high. So I don't see that, easier credit flowing through to the economy and really jazzing up things. If anything, maybe it provides a little buffer. But I think there's still a lot of headwinds, hitting the consumer, hitting businesses at this point.
Which raises the question, Kathy, of whether Fed rate cuts will actually be effective at boosting growth. Will they be the same kind of put, if not on asset prices, then on the economy that they have been traditionally?
Yeah, it's. I think that what the market really wants is that Trump put, and we don't seem to be getting that as much, or at least the strike price is lower. But again, there is good news that the tariffs that will be announced on April 2nd could be more targeted, and those sectoral tariffs, maybe not on top of that. But again, we don't know. But I think with the Fed, I think we have to be careful to think the Fed is just going to come to the rescue. I think they could support growth if needed. But I think, so much really is coming out of the White House. The economic policy changes are really kind of swamping the Fed effect, I think, at this point.
Kathy, is it too early for Jay Powell to call it transitory when, one, we don't know how harsh these targeted tariffs are going to be, and we don't know the retaliation those countries may take on the United States?
Yeah, I kind of, probably like many people, kind of shuddered a little bit when I heard transitory because we don't know. And we could continue to get like this dripping out of tariff announcements. And that could mean that the inflation impact lasts for longer. Even if it's not as big, it could last for longer, and that complicates things, I think, quite a bit. So I think it was a little premature. And I think, they could, the baseline, their forecast is what it, is. Like it does show a temporary increase in inflation and then growth slowing. But I think, putting that transitory stamp, I think that was a little premature.
Kathy, I think some people are confident because they believe the labour market's not as tight as it once was. And the potential for second round effects, the potential for people going out and saying, I want a bigger paycheck, and the company actually following through and delivering one, is somehow been dampened by the increasing employment anxiety that we've witnessed in some of the surveys over the last month. We got some pushback, actually, from BlackRock's Jean Boivin about 20 minutes ago on that point, and I think it was actually credible pushback. He said you've got to think about the lack of immigration we're going to see over the next several years, and this labour market could well be tighter than people think alongside that tariff effort, and which would make us vulnerable to second-round effects. Kathy, how do you think about the labour market dynamic? Because I think that point is probably the most important one.
Yeah, no, I think that's a great point. Like, yes, it's harder to go in to ask for a raise. Employers have more power right now. But on the other hand, just as you pointed out, John, less immigration means all else equal, a tighter labor market. If you look at the household survey, they dissect foreign born and kind of indigenous, domestic workers here. And all of the jobs that were created according to the household survey last year on net were for foreign born workers, because we have a demographic issue here, right? We have people who are retiring, the baby boomers. So we do need immigration to kind of keep the labor market fluid. And it could get tighter than we all think, especially in certain sectors. Now, whether that transcends to the whole labor market, wage growth going up, maybe a different story, but certainly where immigrants are prominent in the agriculture, retail, home working situations, there you can see some wage pressure.
Hey, Kathy, appreciate your view, as always, and the clarity. Kathy Bostjancic there of Nationwide. We came out of the pandemic and got a lot of things wrong. It was a humbling moment for a lot of people that were in the business of making forecasts. And I think going into this, you've got to be really open-minded about what the consequences might be in the coming years.
Yeah, Jean Boivin's point, and I think it's a really well taken one, is that the U.S. economy isn't falling off a cliff. They think that the U.S. will reassert itself. And in the process, there is a supply-demand dynamic in the labor market that will allow people to keep asking for wages. It's unclear to just assume that these companies won't be able to pass along price increases. Mohamed El-Erian has talked about how companies have figured out that consumers are less price sensitive and less aware of what the price of certain things maybe should be.
So keep asking for that pay raise. Seems to be the conclusion of our conversations this morning.
I think that's the conclusion every day.
Don't give up that leverage.
Of a conversation.
Troy Gayeski of FS Investments joins us now for more on the markets. Troy, welcome to the programme. Troy, you say buckle up. Why?
Well, I think we came into this year with an extremely low, even a 0% probability of recession. And obviously, we're going through a substantial rebalancing of the U.S. economy where the president and the Treasury Secretary are openly talking about recession risk and potentially a far worse recession. And it just takes, or a far worse correction, and it just takes more time to rebalance from a consumption economy to one where there's so much more domestic fixed investment. And as you said before, humility is clearly a term that should be utilized now. And that's one of the key reasons why people embraced asset allocation, so they don't have to overreact when you go through these rougher patches for markets.
So, Troy, let's talk about the data first, and then we can get to the market outcomes. Clearly, the sentiment surveys have been shaken up. We've seen that over the last month or so. There's a question about the inevitability of that pouring, bleeding into the hard data. How do you see the former informing the latter? Do you see it as necessarily one means the other one breaks, or do you think we can avoid that state?
Yeah, I think we can avoid it. I mean, again, recession risk has gone from basically non-existent to maybe 15 to 20%, still a low probability. In times of uncertainty like this, it's best to go back to the hard data and just look at the contributing factors to GDP. And what we know is that consumption is going to be lower. It was already going to be lower this year. It'll probably be slightly lower still, informed somewhat from the soft data. But when you look at the hard data and you think about business fixed investment in particular, and you see this in the Atlanta Fed Q1 GDP forecast, we're talking about 8-9% growth from quarter over quarter. And we're probably going to have somewhere between 55 and 75 basis points of additional business fixed investment in the U.S. So that's a very strong data point. And again, the consumer is certainly weaker than they were 2 years ago, but the labor market's still tight. You look at withholding tax growth, it's growing 6% year over year. Initial claims are still incredibly low. Continuing claims have come up a bit, but they're still very low by historical levels. So when you put that all together, it gets back to the Fed's forecast with all the uncertainty. We're going to have slightly lower growth with slightly more inflation. The Fed is more than likely going to have to sit on their hands, maybe cut by 25 to 50. Not the end of the world, but certainly a much more challenging environment than 23 and 24 for U.S. equities.
In that kind of picture, Troy, do you agree with Jean Boivin of BlackRock in that probably yields are going to remain higher and possibly higher than where they are now? And I'm talking about long-term yields, given the fiscal borrowing over in Germany, but also the fact that in the United States, we have both of the deficit concerns and, frankly, we continue to have inflation that likely will remain somewhat sticky.
Yeah, I'll tell you, if we were long a ton of duration, I'd be very nervous right now. And the reason is partially what you stated, but also think about what we just went through. We went through a significant rebalancing or recalibration of recession risk. And the 10-year only dropped to 4.2, 4.3, right? And we know the Fed is going to cut over the next several years, not dramatically, but dramatically enough to cause a re-steepening of the yield curve. And so we do think there's more risk now to the back end of the curve as the economy continues to go through this transition point. So, yeah, be ready for a yield curve steepener. We've seen it already, and we're going to probably get more of it going forward. Now, obviously, the offset to that is how much spending can be cut. That's still a very open question, as you know. And again, the supply dynamic is still very, very problematic. You know, over 70% of all the treasuries that have ever been issued are going to be issued over the next 10 years. The Treasury is obviously playing with the maturity dates there to keep pressure off the back end of the curve, but that's a lot of supply that needs to be absorbed over a very long period of time.
To Anne-Marie's point earlier this hour, was it incorrect for this Fed chair, or perhaps premature, to use the T word, transitory, at a time when potentially what you expect, the steepening of the yield curve, is an implication that the more the Fed cuts now, the stickier inflation will remain over a longer term?
Yeah, I liked her term, but I sort of cringed myself when I heard transitory again. Back to the humility point, there's just so much uncertainty right now. So stating that, after April 2nd, you're going to have this very clear picture is just not true, because we'll put in a first round. Obviously, we're maybe going after the dirty 15 as opposed to every trading partner we have. And then from there, you're going to have retaliatory tariffs. So there's a lot that needs to play out. And again, when you think back to asset allocation and you think about why investors embrace alternatives or even still own some fixed income, despite, the relatively paltry yield and clear risk that we've discussed, a lot of that gets back to when you're going through periods of uncertainty, you want to have investments that can continue to perform and not have the same degree of volatility that the equity market has gone through recently. And by the way, has gone through the last 5 years and the last 25 years.
We've got to go, but it's good to hear from you, as always. Troy Gayeski there of FS Investments. Troy, thank you, sir. This is the big debate of the moment. Is April 2nd that point of peak uncertainty that we can move on from, or just the start of a new phase, a new wave of it?
And what does that look like if people are hoping for a better circumstance later in the year for all of these investments to come together? It goes to M&A that's been put on hold. It goes to capital investment, which have also been put on hold. And frankly, it goes to hiring decisions, which also have been somewhat stagnant. Is there going to be a resolution moment?
It's going to answer some questions. It's not going to answer all of them, because what happens when it comes to the retaliatory effects of the April 7 effects on even it's just the dirty 15, what happens to their response? And then also the sectoral tariffs. When are those going to come into play? Because Donald Trump has talked about the fact that on Liberation Day, what he calls it, we would have both. And it looks like now we're only going to have one.
Equity futures right now on the S&P are near session highs, up by 1.2%. The opening bell 43 minutes away. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Congressional Republicans returning to Washington today will tackle their toughest test yet. That's negotiating a massive tax bill to deliver President Trump a legislative win. It faces multiple challenges, including the overall size of the deal, what elements to include, and how to offset the costs it will incur. Meanwhile, BYD reported sales that surpassed the 100 billion mark last year. According to its results, in total, the Chinese EV maker's revenue came in at $107 billion, beating analyst estimates and leapfrogging Tesla, which reported nearly $98 billion in 2024 revenue. The last time BYD surpassed Tesla on revenue was back in 2018. And United Airlines is set to begin charging customers more to access its airport lounges. According to the company, individual United Club memberships will now cost $750 or 94,000 reward miles a year for Mileage Plus loyalty program members. The move aims to combat a rise in overcrowding in lounges since the pandemic. That's your Bloomberg Brief. John?
Yahara, thank you. Stop using lounges a long time ago. Find a nice restaurant in the airport terminal, get better service.
Hold on a second. This morning we're getting...
United Lounge is absolutely abysmal. Why would you want to pay up for that?
We're getting a John Ferro Guide to Life. He's going to write a book.
That's amateur hour. You show up 20 to 15 minutes before your flight starts boarding.
Don't use the lounge.
Then you avoid everything.
Okay. I can't. I'm not cut from that cloth. I can't do that. I have too much anxiety. I'm sort of like get to the airport 2 hours before. You would hate traveling with me. I know. That's why we don't travel together. I got 2 hours, guy. 2-3 hours, maybe sometimes for long haul.
I love that we're getting a guide to the John Ferro way of life.
It's like lounges,
you go
Delta
to a store,
and United, just absolutely not.
You just go in. Lounges, absolutely not.
Direct.
You go direct.
Transactional, like the president, just sort of in and out. You know, you get what you need, I get what I need. Up next on the programme, setting you up for the week ahead. Lots of economic data and Fed speak too. Live from New York, this is Bloomberg. The opening bow 37 minutes away. Equities near session highs at 1.2% on the S&P. Bouncing back nicely on the Nasdaq, up by 1.55% going into the opening bow. Trade very much in focus. Economic data will be too in the next couple of hours at 9:45 Eastern Time. S&P PMI data at 145. Bloomberg's Mike McKee will be catching up with the Atlanta Fed President Raphael Bostic. Look out for that on Tuesday. Consumer confidence. Wednesday, durable goods. Thursday, a read of GDP plus another round of jobless claims. And on Friday, core PCE and UMich consumer sentiment, which is now less important after Chairman Powell last week.
Collectively, the sentiment surveys will color the information that we get. Look, how much is it going to be? Any additional tea leaves that we get from the White House that will dictate things? Although I do want to say, to temper this week's gains, or this day's gains, the NASDAQ 100 has underperformed the S&P 500 for a fifth straight week. It has been an ongoing underperformer. Maybe this is just a little catch-up.
Been tough for the Nasdaq, that's for sure. Later on today as well, at 2 p.m. Eastern Time, you'll hear from the President of the United States, Donald Trump, delivering remarks alongside the Governor of Louisiana. So look out for that too. Joining us now from Washington, Bloomberg's Tyler Kendall. Tyler, what are you expecting to hear from the President later on this afternoon?
Well, John, you said at 2 p.m. Eastern, that's when we're expecting those anticipated remarks with the Louisiana governor. There is reporting that Hyundai is anticipating to announce an investment announcement here today at the White House. There had been local reports earlier this year that the company was looking into building a steel mill in Louisiana. That's prompted speculation that the governor's visit to the White House today could coincide with a potential announcement. We know that automakers have been lobbying this White House particularly hard for exemptions and carve-outs when it comes to those tariffs. And one of the prerequisites has been to move production to the U.S. and also to make these investment announcements, something that this White House is keen to tout as a way that their tariff progress is already working. John, we should say that if those sector-specific tariffs do not go into place on April 2nd, that would be a welcome development for the auto industry.
Tyler, I've got 20 seconds left. What's it like to travel with Annmarie?
Oh, my goodness. You have to be prepared with everything just in case that we are cutting it a little too close.
There you go. Is it worth it? Tyler Kendall, thank you from Washington,
D.C. You're living on the edge.
That's living on the edge, is it? Missing a flight in Washington, getting stuck at the airport for longer than you need to.
Woo! Sounds like quite Washington if you're lucky.
Edgy type stuff there. All right. Coming up tomorrow, Cameron Dawson of New Edge Wealth, Libby Cantrell of PIMCO, Abby Yoder of JP Morgan, and Krishna Mamani of Lafayette College from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Miami Open update for Bloomberg TV and radio from Tennis Channel. Alexandra Ayala clinched the biggest win of her career as she took out Australian Open champ Madison Keys in a major upset in the women's draw. The 19-year-old is a former junior US Open winner and trains at the Nadal Academy in Mallorca. And her reaction on reaching the round of 16 was there for all to see.